Of higher iron ore prices and the like. Technology was the real standout sector, though, yesterday, and that was part of the Fed trade, wasn't it? That was catch-up from the Fed the night before. So we're coming off a day where technology did really well. We were up by 3.2% on tech names yesterday. Just ASML itself up by 5.5% in yesterday's session, which is such a heavyweight.
Iron ore a bit softer this morning, so maybe that you get a reversal in the commodities trade. So we'll keep an eye on what is happening there. Anyway, here we go. The Friday session, maybe not quite as frenetic as some of the other sessions we have seen throughout this week, but European markets are now open. An early indication coming through in terms of where the balance is likely to lie. You do have luxury names softening up once again. Novo Nordisk, I think, has got ex-dividend today, so just to kind of be aware of that when you see it on your screens in front of you. But we are seeing LVMH softer. SAP is softer as well. Some of the luxury names are coming down a little bit. I'm waiting to see how some of the footwear names, which I guess you could call fast fashion, they are the ultimate fast fashion, you could argue.
Yes.
Moving quickly. Maybe that's not my running style.
No, I was going to say, it depends on your level of fitness. Not moving all that fast. But anyway, we're looking for that sector, looking to see what happens with that one. We're also looking, I mean, broadly speaking, we do see that FTSE outperformance once again. That was indicated by the futures, so we're up by 0.1% on the London market. Elsewhere, we are weaker. The CAC 40 is down by 0.4%, the DAX down by 0.2%, and the sector picture does look extremely different to yesterday. So we've got technology down 0.4%, banks down 0.5%, consumer products and services is also weaker, and most sectors in negative territory today, as if yesterday was all a bit much. We went off strongly to the upside. All of that dovish sentiment from a host of central banks took us higher, and today we just pause for thought on that particular dynamic.
Nike looks like it's continuing to fall pre-market, so just keep an eye on that. I've yet to see a price on Adidas, so I'm waiting to see exactly what is happening there. We'll also give you some prices on what's happening with Reddit as well. But European stocks this morning, broadly, I think kind of pausing a little bit to Anna's point in terms of what we've seen over the last few days, a little bit of an unwind, maybe a little bit of profit-taking as we carry risk into the weekend. Yeah,
absolutely. So we'll keep an eye on that, the footwear sector. Interesting if you see, we get that read across because we saw it with the luxury names at the beginning of the week. We were talking about that with Andrea Felstead, the extent to which that was a Gucci-specific story and then turned out to just be something that hammered the sector more broadly. Will it be the same this morning? You were mentioning Aston Martin. We'll see if we get confirmation of any change at the top there. It has been talked about for a while. They've gone through quite a lot of CEOs. I was just looking back at the management history on the terminal. And 2020, they brought in one CEO. The CEO at the moment has only been there since 2022. And I think there had been talk of how long that tenure would last. But anyway, that's certainly one we'll be watching. We don't have an opening price on that one, I don't think, either this morning.
We don't have a price on Adidas, don't have a price on Puma. So if we could hurry up in Germany and get some of those prices, that would be absolutely fantastic, and we'll see what's happening there. Aston's run by Lawrence. This is a stroll business, so to be honest, this is an execution role. It's not a strategy role over at Aston Martin in the same way that it would be at other businesses.
Let's get to the broader picture, shall we? We've got to talk about what's going on in these markets in the context of all of the dovishness we've heard from central bankers this week. We talked about this with a number of guests this morning. We talked about it with our colleague Ven Ram as well, the extent to which central bankers, yes, they tell us they're data dependent, but they just really want to get on with it. Let's listen to what Larry Summers had to say on that subject.
My sense is still that the Fed is itchy fingers to start cutting rates, and I don't fully get it. We've got unemployment, if anything, below what they think is full capacity. We've got inflation, clearly even in their forecast for the next 2 years, above target. We've got GDP growth rising, if anything, faster than potential. We have financial conditions, the holistic measure of monetary policy, at a very loose level. I don't know why we're in such a hurry to be talking about moving towards the accelerator.
That was former Treasury Secretary, of course, Larry Summers, talking to the Bloomberg team, in fact, to Bloomberg Wall Street Week. Let us now bring in the views of Maria Vateman, who is the head of equity research at State Street Global Markets and joins us this morning. It's Friday, Maria. We made it through an extremely busy week on the macro front. It does seem as if we've got this dovish narrative building in markets, and even when we see data that comes in hotter than expected, we've got in the very short term some evidence of recovery in the UK economy from recession at the end of last year. We've got inflation data out of the US that's come in hotter than expected, but central bankers are just not focused on that very near-term data. They're focused on a medium-term view, would you say?
Yeah, no, I think that's, good morning, Anna. I think that's very fair assessment that central bankers, and particularly we heard from Chairman Powell, Andrew Bailey, so they really seems like want to kind of get ahead of the cycle and like be kind of forward-looking central banks, which is kind of a departure from the past. So that's interesting. And I mean, historically, I mean, central bankers usually, I mean, execute policy a little bit kind of behind the cycle, so they like catching up, and arguably the record of like generating soft landings are not great. So maybe this time they're trying to get a little bit ahead and had before we're seeing like very serious slowdown.
Yeah, there was definitely a lack of confidence in their ability to deliver a soft landing when we started this rate hiking cycle. It's incredible how long expectations of that soft landing have lasted, perhaps, and we'll see how it turns out, how it plays out. Let me ask you about stocks and how you allocate within equities then, Maria, as a result of this. So you don't see much appetite for small caps, for cyclicals right now. What does that tell us about how confident equity investors are?
Yeah, no, I think that's really the really important point is that market is talking about soft landing, and you see that very much in a kind of top lines. Stocks are rallying, earnings are on average are fine, but actually if you kind of peel like the onion a little bit more, I mean, stocks are rallying. I mean, it's mostly tech that's doing fantastically. If you look at earnings, again, earnings ex tech are not great. Earnings expectations ex tech are not fantastic. So that actually, to me, is not a huge vote of confidence for riskier small cap value cyclical trade. So it's again kind of going for your quality growth, which is really not a not a soft landing expectation. So I think soft landing top line. Underneath, it's more macro-driven corporate profitability, corporate financing, margin stories, which are actually pointing to this hesitation around ability to engineer soft landing.
Maria, good morning. It's Guy. Beata Manthe over at Citi has this morning upgraded her stock 600 outlook. She's taking her target to 540 from 510. 6% upside from current levels. We're trading just north of 508 right now. The three reasons she cites, and I'm interested to get your take on this. One, greater certainty on rate hikes. Second one is year-to-date global growth upgrades from economists, Citi economists, which seems slightly counterintuitive, one to the next, and likely dollar weakness from here. What do you think of those three reasons to upgrade European equities? How big a driver do you think they're going to be, and how much volatility around those issues do you think we're going to see?
I mean, to be honest, if she cited those, at least the first two reasons for US, I would be fully on board. And I mean, yes, we're seeing upgrades to global growth. Thank you to US. Yes, we think, yes, rates are going to be cut probably everywhere. But the reason that rates, this kind of earnings profitability can be withstand, it's really U.S. story. So to me, if U.S. is rallying, all markets have very high beta to it, so Europe will probably get higher. But if we're thinking about relative allocation, I would rather allocate to U.S., which is more tech, more services, more domestic, than Europe, that is a lot more cyclical.
You got your barbell strategy. You got tech at one end, you got cash at the other. How much pressure are you feeling to do something with the cash right now?
Actually, that's the question I get asked in every single client meeting. So what else can I buy? And people really go and say, okay, can I buy small caps? Can I buy value? Should I buy cyclicals? They're so cheap. And my answer is invariably you have to wait for economy to first weaken and then start to reaccelerating. Because, I do worry about underlying profitability. So you have to stay in quality. I mean, if you really want to find other areas to buy, maybe healthcare, maybe like other large cap stocks, large quality, maybe a bit of energy, but it's about quality. It's about ability to withstand earnings. As I said, I do worry about earnings slowdown outside tech. So that's where we would allocate, but it's kind of tech light. so it's not real diversification, I would argue.
So you're worried about earnings slowdown, and you allocate to the US, I think you said, Maria. Yeah. What would it take for you to switch that to a European focus? We saw just yesterday disappointing data coming in from a number of parts of the Eurozone on the manufacturing side, some better news on services, but things still, not showing real signs of rebound on that Eurozone economy. What are you waiting for to see more, to go ahead with more allocation to Europe?
I think the big reallocation from US tech to kind of value small caps Europe would be when we really see kind of real signs of economic slowdown, and then we see real strong cutting cycle and much easier financial condition, and then we see kind of the signs of recovery coming in, maybe like trough in the manufacturing PMIs, much weaker, much easier monetary conditions. Then you reallocate to smaller cap, and then you get the value rally, and that would be the sign. But you first need to see real economic weakness, and then you go for Europe in anticipation.
Maria, let's segment Europe and the UK. The UK market looks very cheap right now on historical metrics.
Yep.
I keep hearing bids coming in from private equity that are significantly above where the equity markets are valuing these businesses. You potentially got a weakening pound here as well. Does the UK look like a special situation, an opportunity here maybe?
As I said, I'm not a big fan of value at the moment because I worry about slowdown. So you need to see things to get worse, and that's then like kind of looking for the recovery. So I think not yet, but UK probably I would veer towards US before going to Europe. UK is more defensive market. Energy is kind of big and important component, and like oil prices are performing a little bit better. Currency movement needs to be quite more significant than what we've seen so far to be a bigger driver. But potentially UK would be something to keep a very close eye on.
Just going back to what you were saying about Europe earlier, Maria, that the conditions for allocating to Europe sound like they're quite a long way into the future. If you're talking about another slowdown, the cutting cycle, kind of getting well into that, well, we might have to wait till June until it starts, and then getting well into it could be months after that, and then waiting for recovery, and only then buy Europe. It sounds like Europe will be, under allocated to for quite some time.
Yeah, to be honest, if I look at very long series of institutional investor holdings from our custodial database, investors really very rarely allocate towards Europe. So they usually kind of underweight Europe. So that would not be unusual. And that really kind of backs by fairly underwhelming relative earnings trends. So Europe has under-earned relative to the rest of the world for almost a decade, even if not longer. So that would be kind of being underweight Europe would not be unusual. And I do agree with you. That's, at best, kind of end of the year story, if not next year story, going to Europe.
Maria, Apple is struggling right now. Is there an effect there on the wider tech story? Is that something that you're keeping your eye on? If Apple struggles, does tech struggle? Or are these two now distinct stories?
Definitely keeping a very close eye on, especially given investor positioning. Again, the degree of Apple struggles probably need to be put into perspective. So, earnings power has been very, very strong, much stronger than anyone. For a long time. So regulatory issues obviously important to keep an eye on. But overall, sector still has a kind of strong underlying profitability, a lot of quality. Balance sheet is very strong, which is for the whole sector, which is really, really important for us.
I say that you're a terrible reporter.
So it's quality earnings that we like.
No, I don't take responsibility.
Maria, great to catch up. Thanks for joining us. We always appreciate it. Maria Vedmana, Head of Equity Research at State Street Global Markets. Thanks very much indeed. Galderma has opened. This is a big IPO out of Switzerland this morning.
I'll tell you what,
How?
Douglas, 1,000 Americans are dying a day.
Yesterday.
They are dying.
Maybe I'm
That's
using
true.
too strong a word. It didn't go quite as anticipated. Certainly opened below the list price. Galderma has not done that. It is up by 14%. We are going to be talking to the CEO of this company coming out of private equity into public markets this morning. As you can see, a 14% pop. Have they left even more on the table for new investors? We'll be finding out that a little bit later on. Stay tuned for that. Let's talk about the Super Six, the sensational six, as I probably should call them, here in Europe this morning. What are these stocks doing? These are the kind of the core holdings of many people's portfolios. We're talking about what the story was over in the United States with the Magnificent Seven. Kind of the equivalent over here in Europe, and there's a lot of weakness. Novo's XD, but LVMH is soft this morning. Ferrari's soft. ASML is quite significantly soft as well. Schneider is down as well. So that tech AI story is under a little bit of pressure. The market is rotating towards a little bit of safety, Anna, I would argue.
And on a scale of 1 to 10, how would you rate?
Yeah, Nestle having a more product. Yeah, you do see that sort of rotation into more defensive sectors coming through. It's interesting that the sportswear manufacturers and the luxury also under pressure. You wonder whether one is linked to the other. We'll keep those under review. Let us get a check on some of the individual stocks in focus. Joe Easton has a briefing. Joe.
What do you say to
So here's how those sportswear stocks are settling at the open of trading. Adidas and Puma down a little bit. Adidas now down 0.8%, Puma 1.7%. But the bigger hit is in JD Sports. Nike is one of their most important suppliers, particularly in the US. They've invested a lot over in America, and that stock now down 30% this year alone, following their own profit warnings. And then this update from Nike on a sales decline ahead in the first half of the year, weighing on that stock today. We'll have a quick look at some of the postal stocks as well. One of the best performers on the stock 600 today is Deutsche Post. It is the most internationally exposed company. And we had that big jump in FedEx yesterday. Better than expected express deliveries. That's the parcel area where DHL does compete with them. The other firms, IDS, owner of Royal Mail, Big Post in Belgium and Post Italian, more domestic focus, so not a big move there, but DHL doing pretty well this morning. Then a couple of other individual stock movers to bring you. We have got Grifols, an important update from the Spanish regulator saying they haven't found any irregularities in their financial reporting.
How would you rate your response to this crisis?
The stock has been hit by a short seller attack on their financial results. Phoenix extending gains. That was up a few percentage points at the open, 7.5%. It's the insurance and also pension firm reporting a really positive cash flow number. Could be up 25% according to them today. Enel over in Italy, they've given an update on their debt. They've still got 50 billion euros worth of debt, even more than that, about 53. It's a massive debt load. Their market cap's only about 60 billion, so that is really weighing on them. And finally, at the bottom, Dark Trace, a big share placing from KKR, the private equity firm, selling around 2.5% of the cyber security company that was priced at a discount, and it's coming down 9%, a big drop, the worst performer in the UK. Quickly, your morning calls. ING upgraded at Exane, BNP Paribas outperform on that one. This is due to the outlook on share buybacks. The Dutch government looking to bring in a tax means they might accelerate those buybacks, give them back to shareholders more quickly, according to Exane. And finally, in the UK, THG, this one is a buy at Peel Hunt. Now that stock has dropped about 90% since its IPO. It owns protein.com and a bunch of other websites. They say it's undervalued, and that one's up 3% after an upgrade from Peel Hunt today.
Joe, thanks so much. Joe Easton with a briefing from our equities team. Coming up on the programme, we'll continue the stocks conversation. Reddit shares surging on their debut in New York. Could it lead the way to a revival in stock market listings? We'll talk about Reddit and how that performed. We'll also get to one of today's IPOs a little later in the programme. This is Bloomberg.
names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
So it was a narrative that really helped them. Can they continue that? I think that's a big question.
Is the AI stuff backward looking? That's got to be the question here, isn't it?
Guy, that's a really good point, because they talk about how, they were founded in 2005. They've got this body of data of users of, as we heard the executive speaking about people reviewing things like cars. But I think there's this issue of growth and there's this issue of monetization. And now that they're public, I think a lot of the users who've been contributing that backward-looking data, they might not want to use this platform so much. And I've been talking to a lot of Redditors, a lot of these Wall Street bets guys, and they say they are concerned about what happens when this company has to start pushing monetization.
Okay, I think it's really interesting. We talked with Alex Webb at the top of the program about this. The idea that you train large language models on a Wall Street bets chat room. I mean, what kind of conversations with technology are we going to be having in the future?
Yeah, they're probably going to be meme-filled. Maybe.
These AI models are going to be quite confused, I think.
I think they might be. All kinds of human nature in one sort of technology blob. I mean, but what does this tell us about the broader listings story then, Charlie? Because that's also what fascinates us about this.
I think a lot of hope for these companies that have been kind of waiting in the wings is that this is going to be a better year than last year. And when you look at the amount of money that's been raised on U.S. exchanges in IPOs over the past, at this point so far this year compared to last year, it's up about 152%. So it's looking better than last year, but probably not as good as 2021, which was just a bumper year. But we've got a lot of these firms that are waiting in the wings. Microsoft-backed Rubrik. We've got Waystar, which was a healthcare payments company. So those are kind of tech adjacent as well. So they could be very, very happy.
Private equity's got to need some exits, really. But we're going to talk to Galderma a little bit later on in this hour. There's a private equity company the company that is coming to business. How long is the window? How big is the window? How open is the window? If you're a private equity company now, you've been waiting for a long time, do you need to pull the trigger quickly?
I mean, look, Reddit had to wait from 2021 until now. That was about 2 years and change. And, I think private equity, they've got a lot of money, they've got a lot of cash, but they're running low on patience. And so when you look at this market rally and you look at that share price bump, Reddit, marketed in the upper end of that $34. They were able to get 50, I believe, 50.44. So it's a good return, and it seems like it's a good time to potentially go public.
I wonder if they did quite well to achieve a value that wasn't all that far off that 2021 value. If you think about what we were doing in 2021 and where the thinking was and the meme stock craze, that really put Reddit very much in the spotlight. If they were achieving that then, is it impressive that they managed to do that now?
I think they're going to be happy about it, right? I think that private valuation was $10 billion. I think they almost got there when you look at the fully diluted shares. And it was such a different narrative then, right? It was Reddit as the social media company, and now we're hearing about Reddit and AI. I wish I could count the number of times that they said AI yesterday.
AI adjacent.
Exactly.
AI adjacent.
Yes.
The halo effect is massive. Charlie, great to see you. Thank you very much indeed. Bloomberg's Charlie Wells on the Reddit IPO. We're going to continue the theme. We're going to be speaking to the CEO of Galderma, listing this morning. Nice pop in the stock. We'll talk about what that skincare company's future looks like and the IPO scene more broadly. Leo Varadkar has announced that he is going to be stepping down. He's currently talking to media in Brussels. Let's take a listen.
Whatever, I can't remember the quote, but no, definitely not. But I genuinely haven't made up my mind. I want to take a few months to make that decision. Keen to do some more constituency work. We'll be canvassing in my constituency with our council candidates on Saturday. Will be great to have more time to do that, quite frankly. And there's a number of candidates running around the country that I'm very fond of, that I want to help out. Some of the first-time council candidates, people like Regina Doherty, of course, running in Dublin, want to...
Much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Welcome back. This is Markets Today, 30 minutes into our European trading day. European stocks then on the back foot, down by 0.1%, not by much, really taking a breather, catching our breath, it feels, after an incredible week when it comes to central bank policy, monetary policy, lots to talk about there. An overall sense of dovishness coming through from a number of central banks, either the balance of the hawks versus the doves telling us that, such as the Bank of England story, or actually cutting rates as we got from the SNB, or just not terribly worried by hot inflation prints as we got from the Fed. So that's put a fire, really, once again, under risk assets for this week. But today, we take a breather. Stock 600 looking fairly flat. US futures looking flat to positive. Bitcoin hasn't had a great week, but other risk assets seem to have been doing all right. Lots moving in pre-market then, Guy.
We'll talk about Bitcoin a little bit later on. Let's talk about some of the pre-market trades. Interesting that Apple isn't moving a great deal, despite the sound and fury around that stock this morning, the kind of the regulatory onslaught. We have already seen a big impact into its share price. Nike's down pretty hard. We knew that was going to happen, 6.5% on the back of the fairly uninspiring numbers we saw delivered yesterday, or more importantly, the uninspiring outlook for the first half. This is a company that needs innovation. There's a ripple across there. Lululemon, there's a ripple across there as well. Athleisure, apparently working from home is a bit of a factor here, but the stock is down by 12%.
And interesting, yes, so that's the Lulu story. Nike down 6.5%, and we were seeing a bit more read across into Adidas earlier, but it's now only down by around 0.2%, which is kind of just what the market's doing.
It also speaks to this idea that Andrea Felstead was speaking as well, as that actually this could be a positive. This should be a positive for what Adidas is doing. The fact that Nike is struggling maybe is indicative of a positive outlook for Adidas. Let's talk about some of the other stocks that we're watching this morning. I want to talk about an IPO. We talked a lot about Reddit yesterday. We talked about Douglas, which I understand is pronounced Douglas as well. I may have been mispronouncing that one as well. It didn't have quite such a good IPO. That was the German perfume company yesterday. But today, the spotlight falls on the Galderma IPO. And as you can see, the stock is certainly popping. So the Swiss skincare company is up quite strongly today in its trading debut. This follows, I think this is one of Switzerland's, it's certainly one of Switzerland's IPOs, biggest IPOs in the last couple of decades. We're joined now by the company's CEO, Flemming Ormskov. Flemming, good morning. Nice to see the share price up this morning, and thank you for your time and for joining us here on the program. The share price is up quite nicely. So if I'm a new investor, what am I getting here? How much have you left on the table for me? How much more upside does this business have?
Well, guys, first of all, thanks for having me. Well, yes, very good reception. I think if you look at our track record, the last 5 years, we grew 12% on the top line and 2% more on the bottom line. Very strong cash conversion. We have now a very attractive growth and equity story. We will be continuing the strong growth we already have. We have a track record of outgrowing the markets we are in, the segments we're in, and taking share. And we will have 2 blockbusters that we will be launching in the not-too-distant future. So the very broad group of specialist and generalist investors from around the globe, high-quality investors that have been joining us, I think they have a lot to look forward to, probably also why they oversubscribe to our IPO.
Fleming, how does becoming a listed company change the company? You now have acquisition currency. You now have to report in a different way. How different a business is this going to be?
Not at all. So I became CEO in 2019 after having run another public listed company, Shire, and I, together with the team, immediately put all the procedures, processes in place to run it as a public company. This was the goal from the beginning. And the last 2 years, which is rather unusual for a private company, we've been putting out at the beginning of the year guidance. And the good news is we've not only met, we've actually in many cases exceeded or been at the top of the guidance we've given. So we're all set from ESG to financial reporting to how to run a company. All the policies are in place, so not much is going to change.
Yeah, good morning to you, Fleming. Can I ask about where growth comes from in this sector? This does seem to be a sector, the skincare category seems to be doing very well versus other areas of consumer spending. Something structural here perhaps happening. Where do you see the growth coming from? A lot of focus in moving into men's products targeted at men and also targeting younger consumers. I wonder where you focus.
Anna, also good morning to you. Well, I think we're in 3 very high growth segments. So our largest business, about half our business, is in what is called injectable aesthetics. It's a lowly penetrated market. We see significant growth around the world. We're in fillers, biostimulatory products, and neuromodulators, all showing very strong growth. The second sector is dermatological skincare. Yes, we're competing against some really big companies, but we've taken share, done really well. Consumers are really interested in that category. The e-commerce is growing very fast. Asia Pacific growing really fast. And then we are in therapeutic dermatology where you need a prescription. And there we're coming out with a really attractive product called nemolizumab. We showed great growth last year and we have very excellent outlook. So a lot of factors coming together, but it takes us all on the trajectory of being the undisputed leader in pure play dermatology.
You are going up against some other well-known names in this space, Fleming. I wonder what you say to investors who want to know what makes your business special. What sets it apart?
A very simple strategy, an excellent execution, and focus on science and innovation. I think it's pretty clear. We show double-digit growth both in our international business and our U.S. business. We have the largest sales force. We have about 2,000 sales colleagues. We are calling on over 100,000 dermatologists. That's our focus of our business around the world. We do a lot of education. We train a lot of physicians around the world to use our aesthetic products. So a lot of, you can say, feet on the street, a lot of interactions with our customers. We have significantly grown our educational efforts. We've significantly increased our e-commerce efforts. So I think, and we've also become much better at digital. And so I think on all fronts, we are progressing very well. And I think the result speaks for themselves.
Fleming, if we see a consumer slowdown, does that impact you? What do you see when it comes to consumer spending in this area?
Well, of course, we saw very strong spending right after COVID. It slowed a little bit down, but as I mentioned, we were really growing very strongly. We were outgrowing the category. We have very strong international growth. And I think we are in markets like China. We are just at the beginning of what we see as a significant growth opportunity. So I see that, yes, it may be a bit of a slowdown in some of the segments we're in, but given our track record of outgrowing the market and gaining share, I feel confident on also the outlook, even if it slows down a little bit.
What do you want to? I mean, I know that the money, the process you've gone through means that the private equity business that was backing your business is still going to be a shareholder. What's the relationship like there?
Oh, we had an excellent. I'm very thankful. You know, EQT, GIC, and ADIA were our main partners. We've had an excellent collaboration. And I'm absolutely sure they're going to continue to be very responsible, large shareholders. We've added some really fantastic new shareholders, both generalists and specialists from around the globe. We were oversubscribed in all sectors, including long only. So I feel really good about the alignment with the shareholders, the past and the future. And if our main shareholders like EQT decides to sell down over time, they're locked up for 6 months. I'm absolutely sure they're going to do it in a responsible manner. And even during this IPO process, I saw a lot of interest in that area.
Fleming, one of the questions I asked you earlier was about how the business changes, and I mentioned acquisitions or consolidation. Sandoz potentially spinning out its consumer business. Others have spun out their consumer business as well. There is the potential in this sector for kind of a little bit of a realignment, and I'm wondering whether you see consolidation as a theme that will affect your immediate sector, and is that something that you potentially want to be part of?
Well, when we took over in 2019, we basically consolidated 3 divisions into one company. That gave us much more growth. We drove costs down. We had lots of synergies. Our main customers are the dermatologists. We call on over 110,000 of them around the world. So having consumer-related product, having aesthetic products, having prescription products, that mirrors very well what a dermatologist is doing, that she or she needs our products for. So I think we're very integrated, very aligned. We have done a little bit of M&A. We bought a company called Elastin, which is a growth driver for us. It's shown very, very strong growth. It's you could say, in between aesthetics and consumer. We will look, but it's mainly an organic story. We have 2 major blockbusters that we will be launching over the coming years. So we have more than enough internally to show continued strong growth.
I think I meant Sanofi, by the way. I'm sorry about that.
Important. Fleming, thanks so much for joining us. Fleming Ornskov, Galderma's CEO, on the first day of trading as a public company. Interesting that private equity is finding a way out then in some of these stories we're covering this morning, these IPOs. Yeah, because colleagues writing at the beginning of the year talking about how deal makers were really moaning about the prices they could get, or just not coming to market at all, preferring to sit on the old stuff rather than find the new.
Private equity desperately needs exits. Bankers desperately need deals. So hopefully both of those 2 constituencies may be a little bit more satisfied after this week.
Maybe we see those come together. Okay, coming up on the programme, we're going to be talking about cryptocurrency. We spent a week actually thinking about crypto. Coming up on the programme, Bitcoin peels back from all-time highs as demand for spot Bitcoin ETFs falters. We discuss the outlook for digital assets next. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have 2 assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
It's usually taken quite a bit of time for those new products to come to market, get saturated. And I think for us, when we zoom out, given it's only been 8 or 9 weeks, we're just at the end of that first inning of satisfying that initial demand before that next wave of growth will happen, where we're talking about platforms, financial advisors, registered investment advisors, private banks, first getting comfortable and onboarding some of these products to their platforms. And we think that could be the driver of this next wave of adoption of spot Bitcoin ETFs.
Michael Sonnenschein speaking to Bloomberg as his Grayscale Bitcoin Trust and other US spot Bitcoin ETFs posted record outflows. Let's talk about where we are on the crypto story, but roll it into a broader infrastructure story around crypto. We're just going to put up what we've seen on those Bitcoin ETFs recently. Joining us now is Tim Grant, CEO of Deus X Capital, and it's really nice to see you, Tim. Last time we spoke, it was when you were at Galaxy Digital, of course, running the European operation there, now starting up something else. So interesting to hear what Deus Capital is all about. If we could start, though, with sort of sentiment in the crypto space, given the launch of ETFs and what that's doing. We talked to Grayscale about that and the way we're seeing a bit of a rejig as to which ETFs are in favor and which aren't, and some getting outflows. How do you look at the dawning of these spot ETFs in the US market?
Well, firstly, it's great to be back, thank you, and how much difference 18 months makes. The first time I came here, we were staring down the barrel of the FTX debacle, and in fact, that very day, I remember going to speak to the Treasury Select Committee, and by jingo, did I get a grilling about what was going on, and look how times have changed. We've now got 12 billion of inflows in US ETFs, and I think that's just the amuse-bouche for what's going to happen next. Like, everything's happening in the order that you would expect it to when it comes to institutional adoption. Now, in the short run, there's always going to be changes in sentiment, and we've seen some outflows for sure. We've seen a little bit of a retreat on BTC and other crypto itself, but let's just remember, not that long ago, we were in the doldrums, and here we are at near all-time highs. So I think generally maybe this is a moment of consolidation. We've had a nice big 2-month run-up of excitement, those inflows. We've got the UK making announcements, although a little bit half-hearted, I would say, on the ETN front. It's all going in the right direction, but I think everyone's taking a moment perhaps just to step back there. Right. But no question the sentiment is good.
So sentiment is good. You think the market then, institutional investors, you think they really are able to move on from FTX and Sam Bankman-Fried and everything that's happening? I mean, we're following the legal story over there very closely, and clearly that still, I mean, I assume it casts a shadow, but you don't think so. Does it come up in conversation?
It's always in conversation in our world, although you've sort of forgotten about Sam Bankman-Fried, as we like to call him, and now, of course, he's back in the news because we'll see what his fate actually is going to be. But Michael Lewis did us all a favor. He really gave us the inside scoop on what was going on, and I think we've all moved on. I think the fact that BlackRock is really driving a lot of this, that Goldman Sachs is talking publicly about the volumes they're trading in the derivatives world, the crypto derivatives world, on the CME and beyond, tells you that this is yesterday's news, and now everyone's looking forward to crypto being in the regulatory perimeter, and I think the Bitcoin ETF is that amuse-bouche for that. But I think what everyone's really thinking about now is, well, what happens next? This is the moment to invoke the classic Bill Gates comment about technology, that everything's overestimated in terms of impact in the short run and underestimated in the long run. And I think the Bitcoin ETF is a bit like that. We've been hyped about that for months. It was great to see it come through, and we were talking at the tail end of last year, will it, won't it? Well, now it has. Now it's will it, won't it, with an ETH ETF. Well, it will. That in and of itself isn't really the exciting part. The exciting part is This leads to ETFs being used as collateral in lending. This leads to increased volumes in the derivatives markets. That allows other players to come in. It allows us to go and create structured products, which brings the wealth management herd in. And all of this is happening right on cue, right on schedule. So it's exciting to see that evolution.
Trading this morning, 66. I'm hearing calls we could get down to 50, that the halving story has been overestimated, and if we don't see momentum, we could see quite a lot of downside here. The outflows are picking up. How do I know that this is that long-term story? How do I know that this should have a place, given the volatility in my portfolio? How do I know that at this stage? Isn't it too early to make that deduction?
Well, I think if you're trading in the short run, and we do have in our own portfolio short-term trading units, then we're going to be looking at that sentiment. We're going to be caring about how rates are going to affect BTC, how inflows and outflows might affect sentiment, and vice versa. But if you're thinking long-term, if you're thinking strategically, or thinking about the growth of the market, everything is going in absolutely the right direction there. Now, the halving is an interesting one. I love to think of it really in basic terms as a commodity business. So if you're going to reduce the rewards for miners, then the logical outcome is that the large players are going to succeed, and those without scale won't. It's actually, there's a corollary here in the ETF market. If you start cutting fees, who ends up winning? BlackRock and State Street and Vanguard. Well, that's what we're going to see. So those big miners, I think, are going to be quite successful in this next leg, and that's the way we're looking at it. And remember, there's a lot of miners who are publicly traded on the NASDAQ, and so that's an institutional marketplace already. Everyone's thinking about that commodities value cycle. In terms of the halving beyond that, it's not perhaps as big news. I think you're right, as people had thought. If you're in the microstructure of mining, it matters. But in terms of that bigger picture, and this, I think, goes back to your point of when people think about allocating this to their portfolio, who's going to be giving them the advice to do so? Well, when we get through this ETF moment and we start to see the thundering herd, the Morgan Stanleys, the UBSs, the big wirehouses, which together represent trillions of dollars of wealth, starting to inform their clients that a 1 to 2% allocation of Bitcoin is going to have the right kind of characteristics in your portfolio, because it's a high vol asset with the right kind of correlation that will give you the right kind of aggregate.
Do you think the
That's
big
a good story?
A lot of people invest through lifestyle portfolios. Do you think those lifestyle portfolios from those big names that you've just been talking about, the Vanguards, retire in 2045 or whatever the lifestyle fund is of your choice? Do you think those are going to include Bitcoin anytime soon? Or do you think the volatility, the risk metrics around it are still going to be too high for those lifestyle funds to include them?
The indications that we're seeing from those big wirehouses is that they're already preparing the analysis for this. In some respects, this has already been done. You know, for BlackRock to have gotten into this in the first place, that they would have had to have done this analysis, this advanced analysis on what does it do when you add a little bit of crypto into your portfolio. So I think the argument for this is a net positive is quite solidified. The next question is, how long is that going to take to trickle down into the thousands of financial advisors on the ground in the US, as an example, where they start telling that story to their customers? You know, the 60-40 days are over. It's really not that simple anymore. You've got to start to put together portfolios that represent your reality. And I think there's a lot of people, both institutional and individuals, who could really benefit from an allocation. And if we get that small 0.5%, 1% allocation, that's tens of billions, hundreds of billions of allocation to this space, which can only help it grow.
So Deus Ex Capital is about, you say, the picks and shovels, the infrastructure behind Bitcoin and the cryptocurrencies that we've been talking about. So this is around distributed finance and the like. So you're putting money to work in that space. What are the opportunities, or what are the problems that need fixing, for which that is the answer? Because sometimes people have said, you know, all of this technology has been floating around for a long time in search of a problem to fix.
Well, I remember the second time I came on when we were in New York, we were in the doldrums, and the question was, what do you focus on? And the answer was, focus on the builders. That was the story then, and I don't think that's changed. And those builders during that last bear cycle that kept working hard, that kept their eyes on the prize, and that were well capitalized, are now coming out with products that can be applied, and I think that's exciting. So from our perspective, if the corollary of the ETF announcements and that positive reception is that we're going to see more derivatives, we're going to see more institutional infrastructure that requires collateral. That's the lifeblood of capital markets, is providing collateral, lending and margin. You've got to see prime brokers get into this space. The traditional prime brokers are not providing leverage to the large hedge fund clients, and that's the liquidity that will drive a market. So you've got smaller players who have less access to risk capital. That's a big movement that we see next. The institutionalization and growth of prime broking, the provision of margin and leverage. And the other thing that we haven't seen really remedied after the beginning of last year, we'll cast our memories back to Signature and Silvergate. Those companies were providing an important service, which meant instantaneous settlement amongst players in this ecosystem, and that they went overnight, and that really hasn't been plugged, that gap. That's regulated basic plumbing in the industry, and I think there's another opportunity there to see that come up, and we're seeing good players come together.
Tim, is there a link between, so you talking about the picks and shovels and the opportunities you see, is there a link between AI and blockchain? We talk all the time about AI, and every business seems to, and every sector seems to want to be able to attach itself to AI or be AI adjacent. How much does that apply to the blockchain story?
Yeah, you always want to be a bit careful, don't you? Because you can sprinkle. So it used to be you sprinkle some blockchain fairy dust and you get crazy valuations. You remember those times in 2017. And we've thought a lot about this, and we've had some activity in AI in our portfolio for a while. And actually, I think the answer to that question is yes, it's going to be quite meaningful. AI plus blockchain really gives a whole load of capability that we haven't even thought of before. And really, if you think of NVIDIA GPUs, the application of that kind of computing power to things like MEV, which is a very niche-y topic in the crypto space, but it's another part of the lifeblood of creating an efficient market. Okay. We see that being applied and very, very usefully.
Okay, somewhere to focus on. Tim, thanks so much for joining us. Tim Grant, the CEO of Deus Ex Capital. We have come through a busy week, Guy. There's still... Yeah. There are things happening today, but it's a little quieter.
Hopefully it gets a little... Next week feels a little quieter as well. Stocks have had a fantastic week this week. There are things that are still coming up. I just want you to be aware of what's coming up at the beginning of the next hour. So we do have the IFO business climate coming up. IFO is kind of one of those numbers you do want to pay attention to. I think Francine and the rest of the team are going to be speaking to IFO. So to pay attention to that, you'll get some instant analysis. Bostic speaking later as well. Atlanta Fed President Raphael Bostic, again, he's been slightly more... It's going to be interesting to see how his comments fit with what we heard from Jay Powell.
Is he as relaxed about the inflation story in the very near term for the last 2 months as Jerome Powell is? That'll be interesting to watch. So
you've got this leaders summit. Apparently there's no farmers there today, so that's going to be an easier summit maybe to deal with. You've got Nagel, Lane, Holtzman and Centino also speaking. So the central... Actually, I think the central bank story continues because it's kind of this verify aspect. Can I confirm what Powell said, and does he have... Is he at the centre of the committee, or are there some big outliers now?
So the US story around that continues. The European story continues. Will any of the voices we're going to hear, I'm sure they won't be drawing direct lines to the SNB, but this is coming after we've seen the SNB already move on rates.
You can cut rates?
Yeah, you can cut rates, and you can cut rates before the Fed, which prompts the question, at least, of the ECB, doesn't it? So that could be where the conversation goes a little bit later on. We're also going to hear from Pascal Donohoe later on. We've been watching, of course, all those arrivals taking place in Brussels, and that conversation will be coming in the next hour of programming, I think. So talking about the Eurozone economy as a result of that. That's coming up on the Pulse.
It is. So Fran's got some great guests coming up. I think Ollie Crook's going to be talking to Pascal Donohoe, but Fran is going to be talking very shortly to the president of the IFO Institute. Clemens Fuss is going to be joining her. This on the back of some really disappointing manufacturing PMI data that came out of Germany this week. So I think that's going to be fascinating to hear exactly how he deals with that. But the service sector in Germany still looking very strong.
Yeah, the service sector wasn't too bad, was it? But it was that manufacturing story that looked extremely weak. So how does that economic story evolve? We will focus on that in the next hour. That is it for markets today. The Pulse is up next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies. Bloomberg, context changes everything.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Stocks are heading for their best week of the year after a raft of central bank meetings indicate that a pivot towards a looser policy is on track. Double trouble for Apple. The iPhone maker loses more than $100 billion in value after it's sued by the U.S. Justice Department over antitrust violations. Across the Atlantic, European regulators prepare their own probe into the company. Plus, Nike shares fall further pre-market as the world's largest sportswear retailer also looks to realign its product offering. Well, it's Friday. We've made it. It's been a very busy marathon-like week for central banks. So let's get straight to the European markets map. Now, a lot of the focus, of course, will be on what we heard overnight from the U.S. Now, stocks had a great week. Let's not mince our words. They've had a great week so far after this raft of central bank meetings really indicated that a pivot towards looser policy is on track. Now, investor appetite has been rekindled, frankly, since Wednesday. This is after the meeting from the Fed, fueling hope that U.S. policymakers will deliver 3 interest rate cuts this week. A couple of things we need to watch out for. I know Alphabet was down yesterday. Apple was also down. For the moment, a lot of European stocks are a little bit in a wait-and-see situation, but I'm also looking at dollar climbing 0.4%. This is a picture for U.S. futures. So across the board, if you look at U.S. futures, after the pretty incredible week that they've had, maybe they pause for a little bit of reflection. This was also S&B week. It was also BOJ week. So let's get straight to after those futures in the U.S., a little bit on the upside, but really not changed by that much. Yen, also a little changed, trading around 152 per dollar as Japan's inflation accelerated to the quickest pace in 4 months. And then I'm also looking at renminbi. Probably the most interesting story, certainly today, gaining some 0.6%. We're getting some breaking news. The data, always important. This is what probably will drive markets forward in the next couple of weeks and months. So that Germany, March, IFO Business Confidence Index coming in at 87.8. The estimate was 86, a little bit better than expected. At 9:30 a.m. UK time, we'll speak to the president of the IFO Institute, Clemens Fuest. France and Germany over the last couple of days kind of disappointing when it comes to data. So always interesting to get his perspective on what Germany needs to do now to kickstart its economy. To talk about the markets, Germany, but also the U.S. We're joined by Karim Shadid, Chief Investment Strategist for iShares EMEA at BlackRock. Karim, as always, thank you so much for joining us. What a week. We've made it to Friday.
Made it.
We've made just about, I mean, we still have a whole trading day ahead, but it's incredible. You have the S&P. It actually surprised a lot of people, but it seems that even the BOJ, everything was well telegraphed. So it was really the Fed giving hope with this risk-on attitude.
Yeah, absolutely. And, you know, taking the cue from the BOJ for a second, I think we've seen the exit from the negative interest rate policy, but it's really interesting that even though they telegraphed it really well and they have technically exited the yield curve control policy as well, the backstop has not been taken away. And markets have run with that. So, you know, we're seeing that positive risk for markets. And when I tie it back to our asset allocation views, Japanese equities are one of our key overweights.
But is there a concern, Karim, in your mind that actually, so, you know, the BOJ has hiked at last, but actually it's not a liftoff. This is not going to be a sea change. It's not necessarily the start of a new cycle with this rate hike.
Exactly. And this is why I would put the BOJ in a different bucket, because this is the end of negative interest rate policy. This is not the start of a tightening cycle. They are still very firmly accommodative and in supportive policy. And then when we look at the Fed and even the BOE to a certain extent, if we zoom out, the big picture is this is a good environment for risk assets because we are inching closer to rate cuts, even if they're not happening this week or tomorrow. But this is not the end of inflation volatility. We did have a couple of volatile numbers in January and February. And so when I think about the TAA, risk on, when I think about the SAA, I think getting more dynamic because of this volatility in macro.
Okay, Karim, let's also bring in Justina Lee, of course, from Bloomberg. Justina, thank you so much for joining us. China kind of also left, right, and center, but didn't really move markets, except for today. There's quite a big move in yuan.
Yeah, one thing that was really interesting is that obviously we're seeing dollar strength everywhere, but the yuan move specifically was partly triggered by how the central bank fixed kind of the currency at the open, meaning that it kind of signaled to markets that it was willing to tolerate a bit more weakness. Now, part of that is probably because they're seeing dollar strength all around the world, and so they understand that it's not like you can kind of like fix the currency from its true value for a really long time, and that's why we are kind of seeing the weaker yuan today, but also a big move down for Chinese equities on the back of some concerning earnings.
But because basically traders, you know, say, look, there's a weak corporate guidance, and I guess Beijing at the same time is relaxing its grip on the currency, so what am I left with? Are those some of the questions that traders are asking themselves?
Yeah, and I think Chinese kind of policymakers are really in a bind here, right? Because they've been signaling kind of for the past couple of weeks that there's going to be another reserve requirement ratio cut. But then the problem is if you're easing monetary policy to kind of prop up growth, then naturally your currency will decline. And all along, I mean, China has always been quite uncomfortable with too much currency weakness and too much outflows. And I think they're kind of back in that position where they're having to grapple with those forces at the same time.
Karim, what's your take on China? I mean, I know there was a lot going on this week, so maybe China wasn't left, right, and center, but it's always those interesting weeks where you understand maybe that, you know, Beijing is trying to do something else than what we think they were.
So when I put it into the context of our portfolio views, you know, emerging markets, one thing we're seeing is that with developed markets in risk on and risk appetite quite positive to add to equity positions in places like the US and even Japan, we're seeing a little bit of more of a lukewarm sentiment from investors, and we see that in some of the client conversations that we're having around EM, but there is selectivity in EM. So when I look at the flow picture, Jan and Feb, very strong flow months for emerging market equity ETFs, but mostly in single country exposures. So thinking about more precision exposures as opposed to just the broad bucket.
I mean, the other two, I think, stories of the week is probably what's happening with gold, definitely, you know, for the first time ever touching 2,200, and then Bitcoin trade around 66,000. So actually we had that record high, you know, 10 days ago, and it's now not doing as well. What are some of the forces? Is it all to do with central banks, or is it also positioning ahead of something?
I think that behind those two rallies is probably kind of the expectation for rate cuts. But it is, of course, kind of interesting because we think of like gold as maybe like a safer asset, and then Bitcoin is kind of all about speculative fervor. And I think kind of Bitcoin has had really kind of extreme run up. And so we're just kind of seeing a bit of a pullback in sentiment. And we're also starting to see some outflows from those Bitcoin ETFs. And I think that's kind of contributing to the move. But it's always kind of hard to tell with crypto, isn't it?
Yeah, but it is, which is kind of like confuses, but also it feels like it's these like opposing forces, but at the same time, it's part of the same movement.
Yes, I'm going to be more contrarian here.
I like that.
Yeah. Look at the gold-silver ratio, because gold, it's been all about gold, and we like gold. We've been quite positive on it. We've seen, we haven't seen the flows, even though we're positive on it, the price action. So it's a bit under-positioned. Obviously, central bank purchases have been a big driver of that metal, precious metal. But if you look at silver, that gold-silver ratio has been hit record levels at one point in recent weeks. So silver has been lagging. So one thing we're seeing is some catch-up relative value trades on silver relative to gold, because some of the fundamentals that drive gold also drive silver, but it hasn't caught up.
And this is what, the world economy, or is it just an inflation play?
It's not.
I'm unclear what gold is doing right now, if I'm honest.
Exactly. So gold it tends to be more of a safe haven. It has become more stable because of the more sticky purchases from central banks. Silver is a mix. It's a precious metal, but as you say, world economy, it has a bit of an industrial usage as well. So you could think of it as a trade where you're putting a bit of an upside tail risk on the world economy upside hedge with silver, but mostly also a technical trade, if you believe in technicals, because that ratio looks too steep.
Does anyone not believe in technicals?
Yeah.
No, I'm kidding. Justina, I mean, when you look at industry, it was a big week for luxury, because we had Kering, the company that owns Gucci, really disappoint. And then you had this, Micron kind of flying off the shelves, giving us a lot of hope on semiconductors in general. But then Alphabet and, of course, Apple being smashed because of regulation.
Yeah, it's really interesting, because we used to think of Magnificent Seven as a group, but more recently we have seen kind of some diversions within Magnificent Seven. I mean, obviously it's been kind of interesting to observe that NVIDIA is kind of still kind of fueling so much kind of enthusiasm and still going up further, kind of on the back of the recent announcements about some new chips. And I think it's been kind of interesting. Like, if you look at the stock market and look at like the momentum strategy, where you're just kind of buying the past winners from the past 12 months, I mean, that's been going up like a straight line. And I think it's a sign of like kind of how kind of positive sentiment is. And everyone's just riding the same train here, which always raises the question. I mean, is it like kind of a too crowded trade at this point?
Okay, I love so many questions getting you started for the weekend. Karim Shadid, Chief Investment Strategist for iShares, the EMEA, and BlackRock, and Bloomberg's Justina Lee. Now, let's look pre-market. Sportswear brands Nike and Lululemon dropping after they both lowered their sales outlook. Nike says it expects revenue to fall as it shuffles out older merchandise. Lululemon says the U.S. market has slowed down, both under pressure. Coming up, we'll be talking to Pascal Donoghue, the Eurogroup president, and Ireland's Minister for Public Expenditure and Reform. That exclusive conversation is up next, and this is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? investors, particularly in Europe, more and more place value on what we're doing in sustainability. Many of our partners have expectations on sustainability.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
EU leaders continue to meet in Brussels today, with the bloc set to impose tariffs on imports of Russian grain as early as today. Negotiations continuing over $1 billion worth of support for Ukraine using profits from frozen Russian assets. Now let's go live to the summit in Brussels, where Bloomberg's Oliver Quirk is joined by a great guest. Ollie, over to you.
Great. Thank you so much, Francine. Yes, we're joined right now by the president of the Eurogroup, Pascal Donoghue, who joins us now here in Brussels. He's about to speak with EU leaders alongside Madame Lagarde. So I'd like to begin there in the sort of European economy. All of the CEOs that I speak to, particularly in Germany, particularly in the auto industry, there's a lot of concern around 2024. What are we expecting in terms of growth in Europe and critically in terms of inflation?
Well, we are going to be expecting growth in 2024, and we can expect inflation to continue to fall. The growth isn't as high as we would want. But even though we do have growth, we, alongside that, are going to have record levels of employment. So we do have to acknowledge the uncertainty and the risks that are confronting Europe at the moment, mainly because we are so close to the war, but we are still in a phase of growth, albeit low growth.
And do you think that inflation will get to that 2% in the sort of next year or two, or do you think that it actually could have a longer tail?
I believe it will get to 2%. I believe the right decisions are being taken at a monetary and a budget policy level to contribute to us getting to that point.
And I want to talk a little bit about what we're here to talk about, what the EU leaders are talking about, because as the president of the Eurogroup, few people know the minds of European finance ministers as well as you do. What do you think we will get in terms of seizing not the Russian assets, but the profits? Will we get an agreement today? Do you think that there is the will there?
I think it will take some time to get to that agreement. The main point being that the Commission published their proposal on that this week. It now has to go to member state governments here within Brussels, within the European Union, and be considered in various technical and ministerial meetings that will take place. And that will just take time to do. But there's momentum behind us, and I believe progress will be made. But what will now happen is this proposal will go to member states of the European Union, and efforts will be made to continue to coordinate on this issue at an international level within the G7.
And I'd like to get your sort of early reaction as well, because we had a proposal out of the United States on these so-called freedom bonds, which is sort of looking at how to deal with the future profits and potentially package them to front-load much larger quantities of aid to Ukraine. Do you think that that would have buy-in with
Well, this is the kind of issue that will have to be considered now in the context of the proposal from the European Union Commission. I do believe there is a recognition regarding the importance of this issue. But as I said, the proposal has only just been published. It is a proposal that needs to be, and I believe is legally sound, and now governments need a little bit of time to respond back to us. But the key point is that progress has been made, and we need to continue to look at how this matter will be coordinated across the international economic community.
And funding defense is also front and center for your finance ministers and for your leaders. This idea of joint debt, is this a pipe dream, or do you think there's a path to this?
Well, the discussion on that has really begun here today. We've heard a number of member states make the case for us. I think it's fair to say at the moment there isn't a consensus on the matter. However, defence expenditure has now been increased very considerably over the last 18 months. And a few weeks ago, here in this building, Prime Ministers reached agreement on a €50 billion funding package for Ukraine over the next number of years, some of which indeed does relate to defence. So what there is consensus on is the need to build up defence expenditure. That is happening, And the debate is beginning now in relation to a new financial instrument for that, but there isn't currently agreement.
And a quick word on the EIB. Do you think that there will be a rule change, one? And two, does there need to be more money allocated to defense? I believe there's only about $8 billion currently in terms of lending that is earmarked for defense.
Well, I understand the EIB are looking at this issue under their new president, President Calvino, who's doing an excellent job now leading the EIB. They will be looking at what their role is in relation to this, and they have been asked by prime ministers and finance ministers to consider this issue and to report back to them shortly.
And you hold obviously a position also within the Irish government. We'd be remiss if we didn't ask you, do you support Simon Harris for party leader?
Of course I do. I've known Simon for many, many, many years. I believe he has all the qualities that will enable him to be a very, very successful leader for Fine Gael, and will also allow him to be an excellent Taoiseach. We've had a very dramatic week back home.
Indeed.
We'll be saying our current Taoiseach, Leo Varadkar, is here in our last European Council. I believe he's done a phenomenal job as Taoiseach and as leader of our party. And I wish him every success and every good wish in the time ahead, and very much look forward to working with and supporting Simon.
And there will be ultimately a cabinet reshuffle. Will you continue to serve in your position in the cabinet?
Well, that's very much a matter for whoever the new Taoiseach will be. I, of course, hope to continue with my work, but from being through many moments like this in the past, it's a matter for the new Taoiseach, and I'm not going to make his life any more difficult by making statements on it. Of course, I want to continue with my work, but I recognise that it's his decision and his mandate.
Well, Paschal Donohoe, thank you so much for your time here, for talking Irish politics, but also, of course, the very complicated and very vast issues that confront European leaders here and finance ministers, which is namely funding, yes, European defense, but also getting those funds critically to Ukraine.
Ollie, as always, thank you so much. Great interview there with the Eurogroup president. Now we'll have plenty more on Ukraine. We'll have plenty more from Brussels. Also coming up, Apple accused of getting to the top by stifling innovation. We'll have the latest on the tech giant and its mounting problems with regulators. That's next, and this is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Well, Apple shares are narrowly higher in pre-market trading today. The iPhone maker lost more than $100 billion in value yesterday. Now, U.S. regulators are suing it for violating antitrust laws, accusing the iPhone maker of dominating the market by stifling innovation. Well, Apple says the lawsuit is wrong on the facts and on the law. With us now, as always, Bloomberg's Alex Webb, who focuses on tech daily for us. So first of all, Alex, what exactly is Apple accused of?
It's basically accused of sort of squeezing out competition on a number of different fronts. There are things like the Apple Watch, right? Whether it doesn't let other smartwatches interact quite as easily with the iPhone as the Apple Watch itself does. Things like iMessage, where, of course, if you get a message from a platform other than Apple's, of course, most notably Google's Android, it appears as a green message rather than a blue message. There's not quite as much functionality with it. And a big one, which actually is coming to a focus in a lot of places in the world, is payments, right? Whether, of course, if you want to make a payment, there's Apple Pay, but you can't say use Android Pay on your iPhone or indeed any other competing service. So these are the sort of things that they're really honing in on.
So, Alex, was the DOJ much more aggressive than we thought they would be, and what's it going to lead to?
I think the scope of it and the number of things, there are essentially 5 different pillars to it, is probably more complete than a lot of people had anticipated. I think there was a suspicion they'd go for maybe a few of these things. It seems they've gone for a pretty broad palette. That might be a certain degree of hedging their bets in the hope that at least one of these things hits home. But yeah, it's sort of the broadest kind of full frontal assault, as it were, on the kind of Apple ecosystem that we've ever seen.
Yeah. And is it also facing, of course, there's facing scrutiny, in Europe?
Yeah, the interesting thing in Europe, of course, is that, in the US, they are arguing this on the basis of the current law. In Europe, they have changed the law, and now it is looking at whether Apple actually engages with these law changes correctly. There are some accusations that it hasn't. Of course, Apple denies this, but that they haven't, particularly when it comes to payments through other services.
Okay, Alex, thank you so much. As always, Alex Webb. This is a story I have a feeling that we'll talk about a lot. It'll run and run. Alex is like, oh yeah. Coming up, German business confidence rises. We'll get the details of the latest survey. That's coming up with the president of the IFO Institute next. Again, a lot of the focus this week has been, for example, on the BOJ. It hiked at last. We have a great Bloomberg opinion piece saying, look, this does not necessarily mean with this rate hike that there's a new cycle that starts. The other big story this week is, of course, the Fed. That means we've had a market that's been much more risk on than in the last 4 to 5 weeks. The U.S., you can see 2-year 4.60, and the 30 is at 4.41. We'll have plenty more on markets. We'll have plenty more on gold and Bitcoin, too. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale
and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Well, stocks heading for their best week of the year after a raft of central bank meetings indicate that a pivot towards looser policy is on track. Double trouble for Apple. The iPhone maker loses more than $100 billion in value after it's sued by the U.S. Justice Department over antitrust violations, while across the Atlantic, European regulators prepare their own probe into the company. Plus, Nike shares fall further pre-market as the world's largest sportswear retailer looks to realign its product offering. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, German business confidence has come in higher than expected, with the IFO Business Confidence Index rising to 87.8. Now, I'm joined by Clemens Fuß, the president of the IFO Institute. Mr. Fuß, as always, thank you so much for speaking to us on the back of these IFO numbers. Finally, a little bit of encouraging news. How would you quantify this news? Surprising? Is it a turning point, or wait and see?
It's probably too early to say it's a real turning point, but it's the second increase we've seen. We had one in February and now this. So I would say it's a stabilization. And after the worsening data in the autumn and over the winter, I think this is compatible with most forecasts that are saying it's going to be a stagnating economy in Germany in 24, but not a shrinking economy. So it's a stabilization, and that's, of course, welcome.
I mean, of course, the concern is that forecasters are really counting on consumers to try and drive this rebound in Germany. And so far, it's been very, very timid. So what's holding people back from spending more?
It's probably the uncertainty about the future. So many people are worried. We see that real incomes are increasing at the moment. So wages are rising more quickly than inflation or than expected inflation. And that's good in principle for consumer confidence, but at the same time, people seem to feel the uncertainty about the future. But in the data today, we see some bright spots. We see, for instance, hospitality strong. We see improvements in retail. They are coming from a low level. So it seems that consumer confidence is indeed rising, and that's one of the factors we expected as positive this year.
Mr. Fuß, I guess, you know, some of the other things that I guess is puzzling a lot of people is the protracted weakness of Germany when it comes to manufacturing. So the manufacturing sector has been improving all over the world, and certainly in many, many regions across the world and in Europe. Why have we not seen that boost in Germany so far?
So in Germany, many companies in manufacturing feel the uncertainty about the political environment, uncertainty about regulation, a heavy burden of bureaucracy and taxes. And it's quite unusual indeed that the German exporters haven't been able to benefit from this general improvement in the world economy. But again, in the data today, we see an improvement in expectations. It seems that German companies do expect to benefit from this upturn in the global economy. At the same time, we see order books still shrinking. So the improvements haven't arrived, but at least companies are becoming a little more optimistic. Of course, there's still uncertainty about the future path of energy policy. Energy prices have come down, but especially for gas, not as far as necessary to help that sector of the economy.
The labor market has remained fairly resilient, actually, in fact, even because there's this economic weakness. Do you expect that to continue to be the case?
Yes, we do. We see some sectors of the economy, for instance, the car industry and supplies to the car industry, where we see job losses. But overall, the majority of companies is still looking for people. And some companies are actually held back by a lack of staff. So we don't expect an increase in unemployment. And that's another factor stabilizing the economy at the moment. It's a stagnation without a high level of unemployment.
So, of course, Germany has been hit by quite a lot of strikes, more than usual and more than other countries. What does this tell us about wage growth, wage expectations, and the labor market, something that is so important to the ECB and their future policies?
Yes, there is some tightness in the labor market, and that is driving wages. That does increase the bargaining power of unions. At the same time, the strikes in Germany we've seen are often strikes of relatively small unions that exploit their particular market power, like train drivers or pilots. So it's not a very broad phenomenon. The big unions haven't reacted to the tight labor markets by increasing wages or increasing their wage demands massively. There are sizable wage increases, but it could be worse from the perspective of the companies. In terms of the functioning of the labor market, significant wage increases are what is needed, because if there is not enough staff, if companies do not find people, they need to pay more.
The ECB is now, the signaling is pretty clear that they'll start cutting in June. How helpful will that be for the German economy?
From the perspective of the German economy, even earlier rate cuts would be appropriate, but the ECB looks at the Eurozone as a whole, is worried about wage increases in the service sector in particular. It's fine if this comes in June, but that would then really help the German economy. One of the weaknesses in Germany is construction, and that would also help in particular for construction.
There's a latest plan to reduce, for example, the corporate tax burden to the tune of 7 billion euros. Is that helpful, or are there other things that you think would be more helpful for the economy?
That would be helpful. The corporate tax burden in Germany is one of the highest in the G7, so it would be good. But this law got stuck in the second chamber in Germany. So the second chamber, where the states are represented, has already reduced this package. They've said if they agree, they'll only agree to something like 3 billion. So it's become a very small package. It's not going to be a game changer. The direction is fine, but it's not going to change much if it comes.
Mr. Fuss, thank you, as always, for joining us. Clemens Fuss, the president of the IFO Institute. Now, coming up, as EU leaders discuss further tariffs on Russian grain and using profits from frozen assets, we'll be looking at how the Ukraine-Russia conflict has turned into a global economic conflict. That's next, and this is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Well, the proposed use of frozen Russian assets to fund billions of dollars worth of support for Ukraine is the latest effort by the West to deal with Vladimir Putin through targeting the Russian economy. With a rate decision from Russia's central bank later this morning, we also look at how the war and sanctions are impacting the country's economy. Well, I'm very pleased to be joined by Bloomberg's Stephanie Baker, newly minted author of a new book, Punishing Putin: Inside the Global Economic War to Bring Down Russia. So, Stephanie, always great to speak to you. You have some really pretty unique insights. When you look at the U.S., of course, saying that the Ukraine remains stuck on Capitol Hill, and there's talk in Brussels about freezing assets, giving the money to Ukraine. Is there a political will, but a legal stop?
Well, what they're looking at now is taking the profits from those immobilized Russian central bank assets that are currently being earned by Euroclear in Belgium, and using those profits for Ukraine to fund through this EU fund to provide military assistance. And the thinking there is that's not seizing the principal, so that is a lower legal hurdle to surmount. The Euroclear doesn't have a legal obligation to pay any interest on those assets to the Russian central bank. And so that's what's moving forward at the moment.
So I think tariffs also seem to be splitting opinion, right? So some say they work, others say they don't. So would it actually make a difference if there were tariffs on Russian grains?
I think this has grown out of frustration within Europe that they've seen an influx in Ukrainian grain, particularly in countries like Poland, which has created a political problem. And so there's this disconnect. Why are we still importing Russian grain, when we're, flooded with Ukrainian grain? Why not stop or limit through tariffs the amount of Russian grain into the EU?
We're also hearing that the U.S. is actually asking Kyiv, Ukraine, to stop, with drones hurting some of their oil facilities. So on the other hand, it could be effective in trying to cripple the economy. What's the right way to think about this?
Well, I think in Washington, obviously, gas prices are very sensitive in the run-up to an election. And you've seen the price of oil creep up over the past month or two. Frustrated that, the Kremlin's oil revenues are still quite high and the West hasn't done enough. And so they're going to take matters into their own hands. And I think it's a delicate balance of how far they go with this and how much damage they can actually inflict. So far, they've bombed 9 refineries in Russia. And the problem is once they damage some of those facilities, because of sanctions, they're having difficulty replacing some of those parts. So it does slow down their ability to refine products. And that does have an impact on oil prices because I think many people think Russia's going to be exporting more crude oil as a result.
India has also just said that actually it will stop taking oil from certain Russian tanks. Is that true? I mean, are they actually going to do it? Is it a game changer, or is it lip service?
Again, this is finally, Washington is enforcing the sanctions that they imposed. They put sanctions on Sovcomflot, which is the Russian state shipping company. And India is now saying we're not going to take any oil from Sovcomflot tankers. We do not want to be mixed up in any sanctions violations. And they've done that with other tankers that have been blacklisted by Washington. So India, which has been taking huge amounts of Russian crude, is reducing that. It's still taking quite a bit. But I think you're seeing, finally, sanctions enforcement having some effect.
Stephanie, thank you so much. Stephanie Baker there from our investigations team with also her wonderful new book, I think, out now.
No, it's not out.
Out soon.
It's out in early September. We've got
early
a while.
September.
Yeah.
So pre-order the Russian invasion, of course, of Ukraine, left, right, and center. It has been one of the key drivers of inflation across Europe, with the UK particularly exposed to energy imports. Now, the latest data this week is showing a few green shoots of recovery in the UK. Now, inflation fell to its lowest level in 2.5 years. Retail sales actually stronger than expected, and Bloomberg Economics says the British recession is over. Now, some argue this is just papering over the cracks of Brexit. They say the lasting damage of leaving the EU appears to be inescapable. Well, that's the view taken by Matt Winkler, our Bloomberg editor-in-chief emeritus, and he joins us now. Matt Winkler, thank you for joining us. First of all, why write a column on Brexit now?
Well, it's been 8 years, and for one thing, and 8 years is plenty of time to do an assessment. And we have, I think, by all accounts, emerged from COVID-19, certainly in the U.S. So it's a good time to say, all right, what is the situation with the U.K. since we have recovered, so to speak, from COVID-19? And the answer is the market told us 8 years ago that Brexit was a giant step back for the U.K., and the market is telling us today the same thing. So that's the reason for taking this very seriously. And not only that, if you asked the British public, which YouGov did last July, the British public said, we would like to rejoin the EU. And curiously, in an election year in the UK, politicians from both parties would rather discuss Gaza 3,000 miles away than doing something with the EU, which is very important to Britain's health.
Are there any analogies to be made with Brexit?
You know, it's probably the worst market disaster at least if you look at the currency, in modern British history. The pound had a record decline that day, June 23rd, 2016, which was the date of the referendum. The pound has not recovered since then. And today, if you look at the equity market, you look at the debt market, Brexit has imposed a premium penalty, if you like, on British assets. And so investors today have to pay a lot more and suffer a lot more in their returns owning British assets, whether it's debt or equity. And that is a consequence of Brexit. And the reason for that is, by the way, if you break with 40% plus of your trading partner, which is what the EU represented to Britain, you're going to pay a price. And to put that in context, actually, you know, the U.S. Depends on Mexico and Canada. Those are the two biggest trading partners, and that's actually about half of what the EU represents to Britain. And if we did something similar, of course, it would be a catastrophe. So that's what the UK is living with. The public belatedly realizes that, and the market is consistently reminding Britons that the country, in a relative sense, has gotten smaller, not bigger.
And Matt, I guess there's a bigger question of, you know, whether the world has learned anything from populism. I mean, there are those that would say we now have two candidates fairly to the center, and that's partly thanks to Brexit, because some of the more colorful policies have been weeded to one side.
Yeah, I guess, you know, look, there's a silver lining in everything. There's the saying, every problem is an opportunity. And it's true. The center is where you govern best. the center is where you get things done. And so perhaps we are getting to a point where people realize that the kind of politics that is preferred and that is going to be beneficial is from the center, not the right or the left.
Thank you so much, Matt Winkler, our Bloomberg editor-in-chief emeritus, of course, with his new column out today on Brexit. Now, coming up, as Nike warns investors that sales will take a hit this year, we also take a closer look at the retail landscape. That's coming up shortly, and this is Bloomberg.
The way I think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits. That's like, again, like a superorganism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Reddit ended its first day 48% higher in what was the 4th biggest U.S. IPO of the year. Now, the share is currently a touch lower in pre-market trading. Well, Bloomberg's Charlie Wells is with us. So what's behind this price hike? Day one, and it kind of flew off the shelf.
It was a pop, right? I think within any IPO, you're wondering, is it going to be a pop? Show's going to go up, or is it going to be a flop? Are they going to go down? And I think Reddit got so lucky because they've been really kind of spinning over the last few months this AI story about how AI companies can potentially use the trove of data that they've got to help improve their large language models. And it seems like the market yesterday believed that. And this bodes well for other companies who are thinking about IPOing, who are using Reddit as sort of a temperature check. And that temperature check was hot yesterday.
Charlie, another one we're watching, of course, FedEx earnings, which beat expectations.
They really did. They beat expectations on profitability. And I mean, look, when you think about the big U.S. shippers, there's FedEx and then there's UPS. UPS in a lot of ways has been outperforming. They've got a single unified network. FedEx for a long time has had FedEx and then FedEx Express. And there were a lot of kind of, redundancies there. And so that company has been on a real restructuring. And they were able to tell positive news yesterday about that restructuring. And also something that investors like, they were able to talk about $5 billion in buybacks. Investors like it. Share price up 13% in late trading yesterday.
Charlie, thank you so much. As always, Charlie Wells there on some of the U.S. corporates. Now, Nike has also warned that investors, or has warned investors that sales will take a hit later this year. This is as the sportswear giant works to make adjustments to better match merchandise with shoppers that they want to buy. Now, this comes as Lululemon released a lower than expected sales outlook as visits to U.S. stores slowed at the beginning of the year. So for a deeper dive in the world of retail, I'm delighted to be joined, as always, by Andrea Felstead of Bloomberg Opinion. So what's going on with sportswear?
The sportswear market is in a real state of upheaval. There are three things going on. You've got the great rotation, which is the move from, we're still in casualization, but there's a move from, you know, the very slouchy loungewear we were all wearing in the pandemic to more formal styles.
We're more chic now.
Exactly, definitely. You've got the great inflation, pressure on consumers, but you've got this third factor, which I call the great fragmentation. So for many years, Nike, Adidas, Puma, they could sell all kinds of products to all consumers at all price points. And now you've got competitors nibbling away at their sales. You've got On and Hoka in running. You've got Lulu in athleisure. They're all taking bits of their sales. So they, in a way, they're more like mid-market fashion brands, and they've become too reliant on a single product that, you know, really burns bright and then fades. And they have to get a pipeline of new products, and Nike has been particularly suffering with this, and that's what they're trying to address.
So what's the read across for Adidas?
I think that read across from to Adidas is actually quite limited. They're both facing the same big picture, but the new CEO at Adidas, Bjorn Gulden, set out his thoughts last week. He seems much more on the pulse of what's going on. He seems to understand that these brands are fashion businesses as well as sports businesses. And I mean, he came from Puma, which is more fashion focused. He noticed things like in 2022, some of their styles, the Samba, the Gazelle, which are known as the terrace styles, were really heating up because of collaboration, for example, with Gucci. So last year, he really ramped up the production of those styles. But crucially, he's not thinking that this is going to stay static. He's looking at where it might go next, introducing new products and figuring out where he can take that range on.
Andrea, what's going on at LVMH? So we have the number 2, Antonio Belloni, stepping down, and it's a reshuffle. Are they looking for the person to replace Bernard Arnault, or is it just trying to make the business sleeker?
Well, I think we are getting this sort of almost generational change at LVMH. You've had a number of senior executives who worked alongside Arnault either retiring or moving to different roles. But what everybody's watching, every little role, every little change at LVMH is fascinating, because at some point we're going to get the transition from Bernard Arnault to the next generation, and it's really which of his children gets the role. Is it one? Do they split it? What happens? Now, the interesting thing about these senior moves is if it's one of the younger children, do one of these senior executives step in until they're ready?
So interesting. Andrea, as always, thank you so much. Andrea Felstead there from Bloomberg Opinion. Surveillance up ahead, and this is Bloomberg.
Look at the number of women that want to learn the game, young girls that are joining on the team. really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The everything rally is likely to continue for a little bit longer.
I think stocks can continue probably to do well, high quality stocks though.
The winners themselves, when momentum is high, can continue to do well.
There's still very much a speculative fervor within the market.
We've been bullish, we remain bullish. We still, very much seem to be in this sweet spot.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. AMH back in a hot seat. It's been a while. She can tell us where she's been in just a moment. Equity futures on the S&P 500 positive by 0.1%. Four-day winning streak on the S&P 500. 20th all-time high of 2024. The data's pretty decent. Central banks are leaning into rate cuts. What's not to like?
Which is the reason why everyone seems incredibly risk-on, which maybe should make some people worried, but it doesn't, because there's no reason not to. You've got the fiscal impulse on one side, you've got the monetary impulse on the other, and they're both going in the same direction, which is things going up.
Bit of Fed speak a little bit later as well. I think Chairman Powell opening a Fed Listens event. We'll hear from Bostic and Barr. What are you looking for?
You want to know the truth? I looked at this, and he's going to come out and say, I'm so glad, I'm ready to hear and listen. I don't think he's going to try to say anything, but the interesting thing is he's not going to try to say anything. No one's talking about cleanup on aisle 2, Jay Powell.
True.
Which to me is telling, because after December, people said, okay, well, who's going to come out and say this was a bit premature? Now it's clear. It's a dovish pivot that was real back in December, regardless of the data.
We are listening to the DOJ just yesterday. Check out shares of Apple, down yesterday by about 4%, this morning higher by 0.2% in the pre-market. The DOJ suing Apple for violating antitrust rules. Anne-Marie, welcome back. We need to get into that. What stood out for you in that report?
Well, there's a number of things they're alleging in terms of these antitrust. It feels like what they say is that rivals are not able to access the hardware or software that Apple keeps so closely guarded. For me, though, it had to be, they take issue with the fact that if you're an iPhone user and you message an Android user, it's the green bubble versus the blue bubble. And if you read the more than 80 pages of this lawsuit, they actually say social stigma was part of it. So there's a lot of individuals who are pushing back on this and saying, is this going too far in terms of really calling out Apple for a monopoly?
What I found interesting was that previous antitrust suits didn't have a market reaction. All of the sort of legal action in Europe didn't seem to matter to Apple shares. Suddenly, this one matters a whole lot. Is it because of the substance of the suit or because it's just convenient timing and people are souring on Apple after a pretty substantial decline in the face of weakness?
Can I say both? Because the list is long. China, increasing competition.
Exactly.
Take your pick, Bramo. We're down about 11%, I think. Double-digit losses so far year to date on this stock.
Which raises questions. Is it just sort of the final nail in the coffin for Apple not being part of the Magnificent Seven?
You know what was impressive about yesterday, though? Alphabet down year to date, having a difficult year. We've got Apple down year to date by double digits. Throw in another surprise this week. We've priced out rate cuts again over the last year, okay? You've got Apple down double digits, which used to be the market darling of the stock market, the poster child for US tech, and yet still, the S&P 500 is up by close to 10% year to date. Now, we've talked a lot about things we'd be surprised about in January, sitting here saying, okay, if I told you Apple was going to be down double digits in 2024 by the end of Q1, that we'd price out half the rate cuts we had priced, and then said to you, the S&P 500 would be up close to 10%.
What is interesting is this goes to sort of the broadening out and also this question of where are we in this credit cycle? Where are we in this economic cycle? People were saying late cycle last year. Now suddenly Max Kettner of HSBC saying maybe it's sort of early cycle behavior, given the fact that you're seeing, you know, maybe potential signs of weakness, but where? Quits rate? Is that really as good as you can do?
That was quite a change from Max Kettner over at HSBC. I read that story this morning. This is not a bubble. This was his note. We're overweight high yield credit and equities, overweight oil as a play on the global economy picking up. The attitude, the sentiment shift has been phenomenal in the last few weeks.
And it is global. And you're seeing that in flows. People diversifying outside of the U.S. They want to sort of capitalize on a global growth wave, even though people previously said it was from the U.S. and U.S. exceptionalism. Now it's U.S. is crowded and let's move out and try to really just explore this new early cycle behavior. Are we really early cycle because banks are doing maintenance cuts? Central banks are doing maintenance cuts? I don't know the answer to that, but I think that's one kind of new theme that's developing.
I do know that this week is exhausting, so let's get straight to it. Equity futures on the S&P 500 positive by 0.1%. Here's the state of play. Yields a little bit lower. Again, we're down 3 basis points on a 10-year, 423.75. Coming up this hour, we'll catch up with Bob Michael of JP Morgan on the Fed's path forward, Bloomberg's Alex Webb on Apple becoming the latest target of Washington, and Peter Oppenheimer of Goldman Sachs with U.S. stocks cruising to all-time highs. We begin with our top story. U.S. stocks posting another record, heading towards the biggest week of gains so far this year. Bob Michael of JP Morgan Asset Management writes in this: the soft landing continues to unfold everywhere, with the tail risk of re-acceleration or contraction looking equally balanced. What's the biggest risk? Fed policy error. Either they cut rates too soon or too late. Bob joins us now for more. Bob, good morning.
Good morning.
Can you pick one for us? What is the biggest risk out of those two options?
That the soft landing continues to unfold for the next 18 months, and people are still stuck in cash. And every meeting I have, and I've said this for the last several months I've been here, that's the first question I get. I have too much cash. What do I do with it? Where do I go? Everything's gone up in price. What am I going to do? And I sit there and I wonder, how could everyone have more cash yet? Every asset price has gone up. Where the hell is it all coming from?
Truly the everything rally. We've seen it in bonds, we've seen it in stocks, we've seen it in commodities, you've seen it in gold. Can I ask you the question you've asked yourself? Where is it coming from?
I don't know, but I've lived through this before, and it was 1995. We had our investment quarterly yesterday. We talked about it. At the end of 94, it looked as though we were barreling into recession. The Fed had doubled the Fed funds rate. U.S. Steel had defaulted. You had the tequila crisis. Orange County defaulted. Everyone was 100% certain we were going into recession, and everyone was risk off. And then we had that immaculate soft landing. The Fed took the edge off of things. They cut rates from something like 6% to 5.25%. And the markets did fantastically well. And we were talking about, well, surely going into that, credit spreads must have widened a lot. And Lisa Coleman, who runs credit for us, looked at me and said, you ask me this question every 3 months. No, in 94, they were dead flat. They didn't move a single basis point. And we're seeing the same thing. The demons are at work. People are worried about a reacceleration, or we eventually will roll into recession. They're waiting for a better buying opportunity, yet credit spreads are holding in, and there's just still too much cash out there.
Which raises this question, have you shifted your stance a little bit on the margins? You used to say that the biggest risk was really a recession. That was your call. Is this a new call for you? The idea that it's equally balanced now with a reacceleration and potentially a real inflation problem?
Thank you for reminding me that a year ago, we were all so certain that we were headed into recession.
Anytime. I'm here for you, Bob.
After all, the regional banking system did blow up, and it looked as though, and the Fed still went ahead and hiked rates 100 basis points in the first part of last year, and for sure it looked like recession. But in September, we threw that away and went to more of the soft landing camp. So we've done reasonably well. I sit here and we try to find, where is the smoking gun? Where are the demons? Where is there legitimate proof that actually there's a frailty that will become manifest in the downside? And it's too hard to find. And actually, there are more signs going the other way. When we talk to the credit research teams, whether it's investment grade or high yield, they're telling their companies just look better, that EBITDA is starting to go up again, that actually companies are more confident about their cash flow and their earnings. So it actually feels that there's more of a stabilization than downside.
When you talk about where is the money coming from, I'm struck by all of my conversations this week and over the past couple of weeks about how much fiscal money has been pumped into the system and how people who received it and companies that received it aren't going to go out and spend it in some of the line items. They're going to invest in stock market, which is part of the reason why, and the bond market, which is part of the reason why there's this wall of money just flooding in. Is there a concern on the government bond side that there's going to be some sort of coming home to roost with respect to the leverage being transferred from the private sector to the public sector?
I don't think so, and we also looked at the amount of money in plans like ARPA that have yet to be distributed. There's still 44% of the $1 trillion that have been set aside that have yet to go out into the economy. So that's already a sunk cost, so to speak. And you're right, the policy stimulus was literally off the charts. You had to go back, when you look at the combination of fiscal and monetary, to World War II to have any kind of relative metric. But we had a pandemic. It's what we needed. It got us through it. And now we're coming out the other side. It will take time to work down, but it doesn't seem to be a problem. We can't be concerned about the amount of Treasury supply out there when the entire Treasury curve is trading over 100 basis points through the Fed funds rate, except for the very front end, the 2-year. So there's still plenty of demand out there. There is no alternate reserve currency in the world other than the dollar. So there will always be Bitcoin. Let's not go there this morning. It's too early for me to go there. That there will be support for the dollar, and the quickest, easiest way for a large official institution to maintain dollar reserves is to buy treasuries. We're not worried.
But to Lisa's point, do you think down the road you'll ever have this concern of the path we're on in terms of the U.S. deficit?
We are in a world of modern monetary theory where when there's a crisis, even, the pandemic was a big one. The regional banking crisis, people want to say it wasn't a crisis, but only because the policy response was overwhelming. Governments borrow, and the central banks help to underwrite that. But it doesn't just disappear into the ether, right? The amount of fiscal stimulus you get actually goes into the system somewhere. There is a credit multiplier, a credit extension effect to it, and that's helped to boost the economy. And we saw that early this year when the Treasury dialed back the expectation on the amount of issuance, because guess what? Tax receipts were up, which is exactly what you want when you apply that amount of stimulus.
So let's put together some of the things you've told us so far. So the economy's pretty decent. Biggest risk is upside risk and maybe the extension of this cycle for another 18 months. You mentioned the inversion of the yield curve as well. So we've got a 2-year at the moment about 460, a 10-year at 424. Given everything you've told us, how are you convincing clients to go further out along the curve to pick up less yield? What are you telling them?
Yeah, that's a really good question, because the Fed funds rate has to come down to 4% to legitimize the Treasury curve where it is. And for sure, if it comes down to 4%, the front end, the 2-year drops from 4.60 down to about 4%. But 5s, 10s, 30s stay about where they are. It's not so much that, it's looking out into the market, looking into the investment grade credit market where you could pick up another close to 1% going into the high yield market, the securitized credit market. That's where you're starting to pick up yields that are in that 5.5 and higher in high yield, close to 8% range. And those are the kind of yields and credit spreads that will come down once the Fed starts its rate cutting cycle.
You mentioned there was so much cash coming in. Where is the cash going? Where are you directing it at the moment? What are the biggest things you're advocating for?
Well, we do like credit. Just because corporate America looks so good. And I myself have gone full circle on private credit. It's so big, I accept it as a legitimate source of non-bank lending into the system.
Okay, this is a change. What's changed your mind?
Just, well, one, the fact that it's larger in size than the public high yield market, so that's pretty significant. That it is getting out there, it is lending to borrowers. Those borrowers aren't just sitting on it, they're actually hiring people, they're using resources, they're creating economic activity. Even if you think, put some unimaginable default rate out there, 20%, that still means 80% is money good. And while there are problems that are ongoing right now, whether you want to call it an amend and extend or exchanges or restructurings, they're occurring, and they're happening without all the fanfare if they happen in the public market. So it's a strange form of reinsurance to the public credit market. So it's another reason we like the public credit markets, because they just look so clean right now.
I love it. It's like
okay, shoot me to ribbons.
No,
go ahead.
It's like a self-help
It's okay.
group. Good morning. My name is Bob, and I am accepting private credit.
I love how everyone knows that Lisa's just sitting there coming up with the biggest comeback for anyone who's bullish. Bob,
I think it's great.
Can we finish by asking you a simple one, Bob? When was the last time you were this bullish on your asset class? When was the last time? You mentioned the mid-90s. When was the last time you were this bullish?
Oh, gosh. You have to go back to the mid-2000s.
Wow. Does that make you comfortable or uncomfortable?
As long as it's not 2007.
I feel great, because I feel post-financial crisis, we've sort of been in a la-la land where there's been a lot of policy intervention along the way because it was needed to recover from what happened during the financial crisis. And hey, blame us, the baby boomers. We learned about leverage, and housing never went down in price, and we figured out how to blow it all up. And it took over a decade to put Humpty Dumpty back together again. And we see that's what's happening. We see that the 91 births are the largest population cohort. They're turning 33 this year. They're the dominant earner, spender, saver. I think we can toss away the last 15 or so years and look at the period pre-financial crisis, when there will be a demand for capital, there will be a cost to it, and there will be a productive use to it. So I'm very optimistic.
This was thoughtful stuff, Bob. It's great to catch up with you, to kick off this Friday morning and start to close out this week. Bob Michael of JP Morgan, thank you, sir. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg Brief. Here is Yahara Hackes. Hey, Yahara.
Hi, John. Investors took a $113 billion bite out of Apple's market value following regulator moves against the company. The DOJ and 16 attorneys general filing a lawsuit accusing the iPhone maker of blocking rivals from accessing hardware and software features on the iPhone, a claim Apple strongly refuted. Across the Atlantic, the company is also said to be facing probes about whether it's complying with Europe's Digital Markets Act. Tesla has reduced electric car production in China amid sluggish sales and intense competition in the world's largest auto market. Sources telling Bloomberg the company instructed employees at its Shanghai factory to lower production of both the Model Y sport utility and Model 3 sedan by working 5 days a week instead of the usual 6.5. Nike warning investors sales will take a hit later this year, pushing shares lower in extended trading. The world's largest sportswear company says it's working to realign merchandise to better match what shoppers actually want to buy. Nike says revenue and earnings growing next fiscal year as it expects to see a payoff from a $2 billion cost-cutting plan announced back in December. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, the DOJ looking to rein in Apple.
We allege that Apple has employed a strategy that relies on exclusionary, anti-competitive conduct that hurts both consumers and developers.
We'll see how difficult that is to prove. That conversation up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Lisa on the edge of turning bullish. I don't know how that makes you feel.
No, hold
Maybe
on.
just sit on that.
Hold on.
You're just waking up this morning. You're thinking, what should I worry about? Data's decent, Fed's about to cut interest rates, stocks are at record highs, everything's rallying. Lisa is on the edge of turning bullish.
Hold on. I understand why this could continue. What worries me is that the wall of money is going into specific areas that when the tide rolls out, they will crash. I can come up with a bear.
That's a worry. Okay.
Yes. It's hard to see it imminently.
On the edge of bullish.
You get
this close.
Stimulus from every side, so you'd have to
Closest she's ever been.
Well,
never been this close to being bullish. Equities right now positive.
It's almost the weekend.
By 0.1% on the S&P 500. Under surveillance this morning, the DOJ looking to rein in Apple.
We allege that Apple has employed a strategy that relies on exclusionary, anti-competitive conduct that hurts both consumers and developers. For consumers, that has meant fewer choices, higher prices and fees, lower quality smartphones, apps, and accessories, and less innovation from Apple and its competitors.
Here's the latest this morning. The US Department of Justice suing Apple, accusing the iPhone maker of violating antitrust laws by blocking rivals from accessing hardware and software features. Apple shares sliding 4.1% yesterday, wiping out nearly $113 billion in market value. Bloomberg's Alex Webb joins us now for more. Alex, can we start with the victims? Talk to me about this. Who are the alleged victims of these violations?
So it's not necessarily other smartphone making companies, but it could be a lot of people offering services on Apple's platform. So we've heard complaints, for example, from Spotify about the way that actually not only payments are taken, right, that they have to pay a certain cut to Apple if someone signs up for Spotify on the device, but also Apple would not let them tell their customers on the iPhone that if you went and subscribed online, then you didn't have to pay that cut and it was cheaper. there are companies such as the people who want to make mobile payments possible, as in contactless payments. So at the moment, you can only use Apple Pay with an iPhone. One of the things that the DOJ is saying is that actually other services, perhaps even like Android Pay, should be available. So it's a lot of smaller companies offering, I mean, Google is a smaller company, but not that much smaller, who are trying to offer products and services through the iPhone platform, who the DOJ alleges have been squeezed out.
I don't know, Alex, who's waking up this morning, though, and shedding a tear for, say, a credit card company like Visa or a bank that says that they can't have a digital player when it comes to the Apple Wallet. But what is the DOJ remedy? Are they actually going to call for a breakup?
Well, you know, you often talk about behavioral remedies, right? So they'll be forced to actually change some of the setup that they have in the device. We've seen that already in Europe in many different ways, in terms of the menus you have for what is the default, for instance, search engine when you open a smartphone. What is the default then payment service that you would use? These are the sort of behavioral remedies that might be possible. There are other things, of course, you know, other companies, from smart watchmakers, for instance, who don't have the same sort of smooth operation with an iPhone as does the Apple Watch. You have to they could be then forced to open some of those APIs to make it easier for competing devices to have their data, for instance, appear in the Apple Health app.
What have we learned from other such suits facing Apple about the fact that Apple says they need to do this for security reasons?
So Apple often makes this argument, right, that this is about the quality of their service, of the quality of the Apple experience, that if you let a bunch of other sort of unmediated, unchecked apps and services onto the device, then it will be deleterious to the customer experience, but also could affect security. The counterpoint to that argument is that ultimately that's a choice for the consumer to make themselves. If it is true that Apple's service or product lineup is that much better, and that gets worse if you let other products and services onto the iPhone without Apple standing as a sort of gatekeeper in between, well, then that's something that the market should be able to decide itself. So, you know, there is a strong counter-argument to Apple's assertion.
Alex, in a lot of cases that we've heard over the EU going against Apple, shares haven't sold off that much. A lot of people shrugged it off as just sort of window dressing, regulatory theater. Why is this different?
This is probably the broadest kind of full frontal assault that we've seen on the Apple ecosystem, all in one go. We've seen a few sort of, you know, chips taken off Apple and, of course, other big tech companies by the European Union in previous years. The fact that this is obviously happening in Apple's home market is meaningful. Now, whether or not this leads to widespread changes at Apple, you know, this is a long way to go in this, a long way to run. Even if the DOJ were to come out with some sort of victory, the changes aren't necessarily about what changes on the device or changes on the operating system. The fear is that it has an effect on the Apple culture. This is something we saw at Microsoft, that when they were subject to years and years of antitrust investigations and complaints, they became a little bit warier about taking risks. And that is something that ultimately was deemed to have hurt them and made them less competitive in the medium to long term. Obviously, in the extreme long term, they're now the most valuable company in the world again. But there was a good 10, 15-year period where they were in something of a wilderness. That is the concern of the sort of massive effect that could have on Apple.
There's so many different dimensions to this story. Alex Webb, thank you, sir, of Bloomberg out of London. On messaging, great Wall Street Journal op-ed piece that you sent over. Is it federal law to require tech to be interoperable? That's not clear at all. It's not.
It's not clear. So what they need to do is show that this is a proper monopoly, which potentially is going to be very difficult. And we've seen Apple uphold what they do based on security reasons before in court. So this is going to take years.
That stock slightly positive in the pre-market. Coming up, Helene Becker of TD Cowen from New York City. This is Bloomberg.
traditional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Four-day winning streak on the S&P 500. Equities doing okay, positive by 0.1%. On the S&P, on the Nasdaq, up by 0.1%. Yesterday, losses on Apple down by more than 4%. Losses of more than $100 billion on its very large market cap, and yet still this Nasdaq 100 closed at record highs. In the bond market, 2-year, 10-year, 30-year, quite a repricing at the front end of the curve through the week. We've been all over the place. 450s, 470s, 461 this morning. Lisa, we're down about 2 or 3 basis points.
And why not? I mean, honestly, they're just following the direction from the Fed that basically said they're not that concerned about inflation data that came in hotter than expected. They're on the right path, and they plan to cut. Now we have a pretty good sense in the markets that they are going to cut in June. So it's off to the races. You've got federal funding, you've got monetary policy, both on the same page, and let's go.
You know what's had a really good week? And you asked the question earlier this week, and we're going to talk to some guests about it. What's good for banks? Higher rates or lower rates? Banks have had a great week, really stealthy run. 5 days of gains, I think, up 4.7% this week. Best week since December if we close here.
And I know we're going to talk more about some of the capital markets activity, but how much of this is because the green light that we've seen from monetary policymakers, but also from the federal government, has allowed new types of deal making, new types of activity, money just pouring into the system, and banks are going to capitalize on that at a time where delinquencies are not picking up the way that some people had expected them to at this point in the cycle.
Let's finish on foreign exchange. Something that has picked up over the week is the US dollar, believe it or not. Euro dollar's down to 108.18. We're negative by 0.4% this morning, so some more dollar strength. We're leaning into cuts from elsewhere. Cuts out of Switzerland, hikes that don't work in Japan, and potentially cuts in the UK in the not too far distant future too.
The U.S. economy keeps outperforming. There are no signs. Bob Michael just said he's hearing from different executives of small companies. They're picking up. Every single analyst says that they're going in the opposite direction. So at a certain point, why wouldn't people still like the U.S. as much as they don't want to? And you talk to people, we want to diversify. And then it doesn't work. So we just hear this again and again. So that's why people keep coming back.
Literally everything with a dollar in front of it has rallied this week. That's what it feels like. Equities, bonds, in foreign exchange, the US dollar. It's been kind of wild. Under surveillance this morning, the Justice Department taking aim at Apple, accusing the tech giant of violating antitrust laws, wiping out $113 billion in market value. 15 states, plus Washington, D.C., joining the complaint, saying the iPhone maker blocks rivals from accessing hardware and software features on its most popular devices. Apple responding to the lawsuit, saying the case is wrong on the facts, wrong on the law. The news comes as the EU is also preparing new investigations into Apple and Google for alleged violations of rules aimed at big tech. And Lisa, you're right to point out, typically, this isn't a stock story. It's just part of the environment that surrounds the likes of names like Apple, Google, and others too. Yesterday felt different.
And I can't really wrap my head around whether it's because this suit is different in its nature, as Alex Webb was saying, it's broader and sort of challenges the fundamental aspects of Apple, or whether it's just sort of another thing on top of all the other challenges that this company has. To me, it does feel different, though. And the fact that the market responded was unusual given some of the previous track records.
It's been a downpour when it comes to Apple in general. And John, your point to China, you have Tim Cook actually in China right now trying to shore up this market that's incredibly important for Apple. But Dan Ives at Wedbush had this to say: the antitrust lawsuit will, quote, kick off a stepped up phase of the Beltway going after Apple. So is this more in the tank when it comes to the antitrust regulators that are looking at Apple, and potentially are we going to see more of this?
I don't want to reduce it to one thing, but the messaging thing I just don't understand. I don't understand it, and I'd love to hear from someone that does understand it. It doesn't make sense to me at all.
You'll be ostracized from your group chat. They're talking about actual social stigma. The issue I also take with this is that, maybe it's because I lived in Europe for a lot of years, most people are in group chats, on WhatsApp, on Signal, on Telegram. You don't need to be on an iPhone-only iMessage group chat. I'm actually only on one.
You're not locked in. You can use other options on the iPhone. I don't get it at all. And you mentioned the social stigma. The social stigma. Is that something the DOJ needs to be focused on now, the social stigma of messaging?
Of whether or not it shows up green or blue on your phone. It is an important thing that the Congress should be taking up right now.
Are we going to tell Gucci they can't put the label on the handbag anymore just in case there's someone doesn't have a Gucci
and feels guilty
emblem on, and the social stigma of God? That's just ridiculous.
Yeah, I think that they should look into it. I mean, it seems like these are the important things that they should be looking at.
I'm serious, though. If this is where we begin, where does it end?
You know, you're correct to say this. And it's sort of how much are they grasping at straws to try to democratize something that grew up out of a lot of smaller acquisitions over years. Can you backpedal in time and undo that at a time where this is really a pretty aggressively antitrust administration?
The complaint includes a quote from Tim Cook at a 2020 Code conference, and someone raised their hand and said, I can't send my mom certain videos. And then Tim Cook said, buy your mom an iPhone. And that's included in this lawsuit.
Okay, let's move on to a stock that is doing all right, better than all right just yesterday. Social media platform Reddit surging on its first day of trading. Shares climbing 48% and ending the day with a market value of $8 billion. Reddit's most loyal users were able to buy 8% of the shares at the IPO price of $34. The social media company also touting the benefits of artificial intelligence while kicking off the fourth quarter IPO, fourth largest IPO of the year so far. I'm not sure what the AI piece of all of this is, Bramo, but if you saw that move yesterday, a move of almost 50%, I'd be wondering if I'm just about to come public myself, how encouraged I'd be by the move we saw.
That was my big takeaway. Basically, this is a green light to everybody who wants to close out of investments, if you think of private equity, or if you're thinking about going public. And that's one reason why I would suspect banks are kind of salivating and jumping at the bit, because this means a lot more deal activity. I will just say it does remind me of Overstock coming out and mentioning blockchain, and all of a sudden their shares, a furniture maker, the shares surged, right? I mean, how much is it sort of similar? You know, this company comes out and says artificial intelligence, and boom, to the races.
And that's the time we're in at the moment. Let's turn to FedEx, rallying after announcing a $5 billion stock buyback plan. The company's earnings also are beating estimates, and it offered an optimistic outlook despite a difficult demand environment. The results mark a turnaround in its Express division after cutting costs and reducing the company's workforce by nearly 22,000. Helene Becker of TD Cowen joins us now for more. Helene, wonderful to hear from you as always. Let's start with FedEx. The outlook for revenue growth is still not great. Can you talk to us about just how much of the heavy lifting of this company is being done now by cost cuts?
Yeah, that's most of what we're seeing here. The revenue lines were down year over year, and I think that's the key takeaway, that revenue was down, and it's the third quarter in a row where revenue is down and low single digits, and yet the earnings were up. And I think that speaks to the cost cutting that we're seeing. They're in the middle of a $4 billion cost-cutting program by the end of the current fiscal year, May of 24. They'll have done $1.8 billion, and then they'll do another $2.2 billion next year, so that the 2026 fiscal year, they've got $4 billion taken out of costs. And if there's a turnaround in revenue growth, and actually, we can talk about the revenue. A lot of what you see in revenue is fuel surcharges. So in a year or quarter in which you have lower fuel prices, you're going to have headwinds on revenue, and which is part of why it's important to look at revenue excluding fuel surcharges, which actually would have been up.
So there are two things here. Number one is, what are the prospects of growth? Why are people so excited if this is just cost cutting that cannot be continued in perpetuity? I would start there. Why are people so optimistic that this is going to be a more valuable company even after shrinking?
Yeah. So some of what you have here is short covering. There are a lot of people that were short going into the quarter. If you look back over, I don't know, I've covered the company for 30 or more years, and it seems like most quarters the stock does go down on the earnings release. We've just had a couple where the stock's actually gone up. But to the specific question, I think at some point, revenue starts to bounce along a bottom, and then you start to see improvement. You're not going to have this poor revenue environment forever, right? Things do turn around, and you start to get into easier comps as the year goes on, and then they should start to improve. But yes, they're going to be a slightly smaller company. I mean, we're still forecasting that, 2030, 2032, they do $100 billion in revenue, up from around 91 billion now. But yeah, I think the focus in the short term is cost cutting rather. It's one FedEx, getting rid of all the different operating companies, and just focusing on continuing to deliver a high quality product to their customers, to their shippers, so that they can do 3 to 5 or 6% rate increases every year.
Elaine, a lot of people look at FedEx, UPS, although they have their own challenges right now, as bellwethers of this economy, and that typically when the revenues go down, it is a negative sign for consumer spending. Right now, everyone's coming on trying to outbull the other in terms of economic growth and in terms of investing in pretty much everything under the sun. Is this a sign of caution that revenues actually came in lower at FedEx?
Yeah, I think, well, some of it is the fuel surcharge. So, excluding that, you probably had flattish kind of revenues. But yes, they did say that the U.S. was weaker than they expected and that international was not improving significantly and that there were concerns. So I think when people look at the consumer, a lot of what they see is consumer spend, retail spend, or spending for airlines, as we talked about a couple of weeks ago when I saw you guys. And then you think about as people return to their offices, I think 3 things to focus on. 1, as people return, B2B will start to improve. 2, I think we talked a little bit about pricing, so you have that. And then finally, things will start to wear out. Stuff that people bought in 2020 and 2021 will start to have to be replaced at some point. So that will start to show improvement, maybe in another year or so. But yeah, they were really optimistic. They were really upbeat and very excited about a lot of the changes that are happening there. And I think when you think about them being smaller, think about the Express division being smaller and think about Ground being bigger.
When you look at FedEx potentially, Wall Street Journal is reporting a stronger partnership with Amazon. Do you see that coming to fruition?
So that's interesting because, of course, FedEx fired Amazon as a client about 5 or 7 years ago. And now they're talking about getting involved with Amazon really for returns. Returns is big business. And I think Amazon makes it very easy to do returns, right? You can drop things off at various locations. You don't even have to package it up. And FedEx is building that business. And so re-engaging with Amazon for returns may make some sense. When FedEx fired Amazon, they were $1 billion revenue contributor. Versus UPS, it's about $11 billion in revenue. So it's relatively easy for FedEx to replace that revenue, and then re-engaging with Amazon for returns is obviously an opportunity.
Helene, thank you. We've got to leave it there. Helene Becker there of TD Cowen on the latest with FedEx. Can we get the stock up quickly? Just have a look at where we're trading in the pre-market right now. I could do that on the Bloomberg if you can't get that on the screen. I'll do that on the Bloomberg, shall I?
12.5%.
Have a quick look. Is that where we are?
Yeah.
Big move, eh?
Yeah.
Quiet move. Amazing.
Which is sort of raising this question, how come there's so much ambition when it comes to this idea of future growth when all of the positive energy really is coming from pretty significant cost cutting?
Let's get you an update on stories elsewhere. That stock is up by 12.5%. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Ending the fentanyl crisis is shaping up to be a high priority for voters ahead of the U.S. election. A recent Bloomberg News Morning Consult poll sees about 8 in 10 swing state voters ranking the problem as an important factor in deciding their votes. That's more than the number who cite abortion, climate change, labor, or the current wars. Fentanyl has been linked to more than 250,000 deaths since the start of the pandemic. Aston Martin is tapping Bentley CEO Adrian Hallmark to lead the luxury car maker. Hallmark will take over from outgoing CEO Amedeo Felisa, joining no later than October 1st. Hallmark will be Aston Martin's fourth CEO in 4 years. The announcement comes after the UK car maker completed a $1.4 billion refinancing earlier in the month in an effort to ease concerns over the balance sheet. Shares of Lululemon are lower in the pre-market after the athletic maker forecasts a lower than expected sales outlook for the first quarter and the full year. The company says visits to stores in the U.S. slowed at the beginning of the year. Lululemon has had a stellar post-pandemic run and continues to post robust results, with analysts still predicting the company will outperform its conservative guidance. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, the U.S. versus the rest of the world.
Expectations around growth and the performance of equities is expanding outside of technology and outside of the U.S. and into the rest of the world. So yes, it's this broadening out of growth.
We'll catch up with Goldman Sachs up next. Goldman Sachs looking to diversify.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equities on the S&P 500 positive here by 0.15%. Yields a little bit lower by 2 or 3 basis points. We're down to 424.14 on a 10-year. Under surveillance this morning, the U.S. versus the rest of the world.
Expectations around growth and the performance of equities is expanding outside of technology and outside of the U.S. and into the rest of the world. The U.S. does well, too. Japan does well. Asia does well. The U.S. just does a little less well than all of the other areas. So yes, it's this broadening out of growth.
Here's the latest this morning. Market dominance in the S&P 500 leading some investors to look elsewhere. Peter Oppenheimer at Goldman Sachs writes in this: we believe that there are many companies outside of the US that should be considered as part of a global diversified portfolio and should not be ignored simply because their base and listing location is outside of the United States. Peter Oppenheimer joins us now for more. Pete, let's get straight into this because it's a really important theme. If it's winning, even if it's dominant, should I be concerned?
Well, the short answer, John, is no. I mean, the outperformance that we've seen of the US, which has really been particularly dramatic since the financial crisis, has been entirely based on solid fundamentals. The US economy, but most importantly, profits have simply outgrown those of other regions. But as a result of that, its valuation has risen a lot compared to other parts of the world. And now we're finally seeing a bit of a narrowing in the relative fundamentals. Actually, profits are picking up outside of the US, where the valuations are lower. And we think that the US market can still do pretty well, but there's some great opportunities outside, and diversification makes a lot of sense. And that's true at the sector and the stock level too.
Pete, we can talk about those opportunities in just a moment, but can we also discuss what we're fighting? Are we fighting passive flows that just couldn't care less?
Yeah, to a large extent. Look, passive investing has worked very well over the last decade or more in an environment of ever lower interest rates, where bigger companies are becoming increasingly dominant, and the US equity market itself has got the highest share of the world market since the early 1970s. So what's been winning has continued to win and win over time, and that's been a great environment for passive investment. We think that as interest rates stabilize at a slightly higher level, sure, they'll come down cyclically, but they won't come down structurally. Returns at the index level are going to be slightly lower, and that's an environment where the opportunity set is more attractive for active managers, and also for more differentiation and diversification, and that means across regions, across sectors and styles as well.
Peter, when you talk about the case for international, I'm curious where you're looking in particular, and whether it's regional-based or sector-based, as you were just noting.
Look, it's a little bit of both. I mean, the US has done extraordinarily well, partly because it's had a very high exposure to the growth factor, principally dominated by technology, which has been the winning sector over the last decade. We still really like technology. We think that the dominant companies have been justified again in their dominance because of incredibly strong fundamentals. But we think that you've got better relative valuation opportunities outside geographically the US. And indeed, last year, rather quietly, the Euro Stoxx 50 was slightly stronger than the S&P. Many people don't acknowledge that year to date, Europe has outperformed not just the S&P, but the NASDAQ. So has Japan. So it isn't that we don't like the US. It's gone up, it's done well, but there are geographical opportunities to diversify. And I think that means also broadening out from technology. We think technology is still going to be crucially important and do well. But as interest rates come down and we get this soft landing, the opportunity for broadening out into some more cyclical parts of the market is improving, but also into non-tech companies. We put together a list of what we call ETCs, ex-tech compounders. These are global companies outside of the tech sector, which have strong characteristics of reinvestment at a high rate, compounding high returns, and they tend to be somewhat cheaper, and I think also offer good diversification opportunities.
Overnight, Peter, the Citigroup team, the equity team over there, actually upgraded EU stocks with about 6% more upside year to date in their view, and it's one of the highest in the street. This is the reason why. More certainty on rate cuts. We've been talking a lot about that. Global growth, you alluded to that, and dollar weakness. How much is dollar weakness necessary for this call to work?
Actually, I'm less convinced on the dollar weakness part of that story, although I agree with the other comments that you made. The European economy is growing at a much weaker pace than the US. We're looking at US growth this year of around 2.8%, and in Europe about 0.7%. But we shouldn't forget that the European companies that dominate the indices are very global, and therefore they benefit from a recovery in global growth and in the global manufacturing cycle, which is beginning to happen. And I think actually that what we find for European stocks is that growth trumps currency. If growth is accelerating, European companies tend to do well, even if the currency is actually stronger. Now, it may well be weaker, and that will add to its relative competitiveness, but we don't think the currency is actually the crucial part of this. It's much more about relative fundamentals, our earnings improving and as growth improving, our interest rates coming down, all of those things suggest they are. And Europe is only trading at around 13.5 times PE compared to something like 21 in the US. The UK only trades at around 10.5 times, about half the valuation of the US. And so there is a valuation opportunity as well, which isn't really dependent, I think, so much on currency.
Peter, when you look at India and China, you say India has good growth, China can be a value opportunity. A lot of people moved to India because they wanted to get away from China. Why do you see something interesting in both markets?
Well, I think that India is a bit of a different story. It's got high growth rates, both in terms of the corporate sector and in terms of the economy. It's a relatively expensive market, but it's one that has good exposure to long-term growth, and it is benefiting a little bit from diversification of supply chains and indeed diversification of investor focus away from China towards India. China's a bit of a different story, is a valuation value play. I mean, the market trades at around 7 times earnings, much cheaper. Of course, it has a lot more structural headwinds and a higher risk premium given current developments. And it's much less, I think, of a consensus than India. But for a valuation-led recovery, if we get any policy stimulus, we think that there's reasonable upside, at least tactically, in that market as well.
Got to finish on Japan. Pete, it's just been amazing. Nikkei 225 year to date up by something like 22%. I think we had a move over the last year of something close to 50%. Pete, when I buy the S&P 500 market cap weighted, I know what I'm buying. I'm buying mega cap tech in a big way. When I buy Japan, Pete, what am I buying?
Well, I think there's 2 things to say about this. First of all, actually, just like the US, both Europe and Japan have seen an increased concentration by stock. So the biggest 30 companies in Japan, which are very global, are actually the biggest share of the 1,000 biggest that we've seen going back over several decades. So you are getting dominant, large cap, globally exposed companies doing very well. I think that the Japanese market is much cheaper than the US. Of course, it's gone up a lot, but we shouldn't forget it's only just broken through the level that it peaked at last in 1990. And the fundamentals are finally very different because you're getting expanding nominal GDP. We're finally coming out of the deflationary stagnation that's dominated that economy over the last 25, 30 years, but also quite a lot of restructuring stories because of bottom-up focus on improving return on investment from a low level. So with rising margins, return on equity going up, that justifies a bit more of a higher valuation. But the dominant companies there really are global companies in areas around technology, high value-added manufacturing that benefit from a bit of a pickup in global manufacturing cycle as well. And we think they're pretty well positioned, John.
Pete, always enjoy your thoughts. Thanks for being with us. Peter Oppenheimer there of Goldman Sachs on the latest. Looking for a little bit more out of stocks internationally. Nikkei 225, 4 consecutive days of gains. We were talking last week, Lisa, about what would happen. What would happen if they hike interest rates, the yen rallies? What would it do to the Nikkei 225? So they hike interest rates, the yen did not rally.
No.
And stocks keep going higher.
Yeah, basically, this is the perfect combination for people to continue to be bullish because they can buy it at a discount, and it looks like the currency is going to be on their side.
It's quite a run, more than 20% up year to date. In the next hour of Bloomberg Surveillance, we'll catch up with Mohammed Al-Arian of Bloomberg Opinion, Michael Shepard of Bloomberg News, Tracy McMillan of Wells Fargo, and Poonam Gaur of Bloomberg Intelligence. All of that and a whole lot more, with equities closing once again at record highs and adding just a little bit more weight to that rally this morning, up by 0.1%.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
it's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
A lot of investors believe that the Fed is somehow a leading indicator. The Fed is a lagging indicator.
The first few rate cuts that we see are going to be driven by inflation.
In terms of inflation, we've had a supply effect that I think has been maybe even more important than the Fed.
There is a sense that it's not just the inflation point, but the supply point. Our expectation is inflation should come back down towards 2% with growth still being okay.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
At this point in the morning, I think we really need to catch up with an equity market bear, because the bullishness of the first hour of this program has been absolutely overwhelming. We had Bob Michael at JP Morgan Asset Management with us in the last hour. Asked a very simple question: when was the last time you were this bullish? And he said the mid-2000s. Lisa on the edge of bullishness with almost nothing to say back to him when he was on the program.
Okay, hold on a second. Everything he's saying rings true. Companies, from everything that we hear, seem to be making good money. There are some nodes of caution, FedEx, for example. But on the flip side, how do you fight the Fed? And I'm not just talking about the Federal Reserve. I'm also talking about the federal government. How do you fight both prongs, basically printing money?
The enthusiasm is overwhelming, and we had new all-time highs in yesterday's session, even with Apple. The former Dalek of the equity market rally in America down by something like 4+% and losing more than $100 billion of market cap.
Absolutely, and this has to come when you have the DOJ going after Apple, saying that they have a monopoly and how they're structured, basically talking about how other companies, other apps, Jonathan, can't get into their software, can't get into the hardware. This, though, has been years in the making. And one thing I find fascinating about this is we talk about the upcoming election. Will anything change if it was to go back to Trump 2.0? It won't. This inquiry started in 2019 under the Trump administration. So I think the direction of travel coming from Washington is very obvious.
Peter Oppenheimer of Goldman Sachs was saying, look for opportunities outside of America. SocGen have got very different views on this based on their upgrade very recently. Manish Kabra upgrading their outlook from 4750 on the S&P to 5,500. And in a couple of words, just in one single line, Bramo, US exceptionalism is going from strength to strength. Why would you want to fight it?
Well, here's the argument that people are saying, and this is actually exactly the point that I was queuing in on, which is basically you have the U.S. exceptionalism that everyone was talking about being outside of the rest of the world's weakness. It was the one bright light. And now there is a question, is U.S. exceptionalism not being tamped down by the weakness elsewhere, but actually expanding its golden rays across the world with all of the potential profitability traveling through worldwide? This is a key question.
Yeah.
Is it percolating outside of America, or is it remaining American exceptionalism that still hasn't been fully priced?
SocGen, despite widespread market optimism, we view this as rational rather than excessive. HSBC, a little bit earlier this morning. Lisa, this is not a bubble.
That's what people keep saying because the earnings are there. This, though, is really an interesting question. This, are they talking about the equity rally? Are they talking about specific stocks that have gotten bid up very highly? Are they talking about, the equal weight? That, I think, is an important this, because some people are talking about, how there are certain names that maybe have gotten a little over their skis.
We'll discuss this hour. Equities right now on the S&P 500 positive by 0.1%. A little bit of a lift, big lift on the week, heading towards the biggest weekly gain of the year so far. In the bond market, rallying 2 through the week. Yields are lower by 2 basis points. Call it lower by almost 3 to 424.14 on a 10-year. And the euro, weaker, dollar stronger, 108.18 on euro dollar. Coming up this hour, Mohammed Al-Erin of Bloomberg Opinion as stocks hit their 20th record high this year. Tracy McMillan of Wells Fargo on why she says it's time to reduce risk in portfolios. We've found one. And Bloomberg's Poonam Goyal as Nike says sales will be squeezed during its sneakers shift. We begin with our top story. Another day, another record. The S&P clocking its 20th all-time high this year on optimism. The Fed will be able to engineer a soft landing. Fed speak picking back up today with Powell, Barr and Bostic all on tap. Joining us now to discuss, the president of Queen's College Cambridge, Mohammed Al-Erin. Mohammed, let's get straight into it. How overwhelming is the enthusiasm of the last week for this market?
It's totally overwhelming, and for good reason, John. Initially, we had bottom-up drivers, secular themes that were very powerful. But that rally was narrowing. Now, suddenly, you have a very powerful top-down factor that has come in, enabling central banks that clearly are going to do what they want to do, regardless of selective data focus.
Well, let's talk about the Fed if we can.
These two things coming together are really powerful.
We did the pre-game together. We didn't do the post-game. So you were with us, fortunately, going into that news conference. Were you surprised by what came out of the news conference with Chairman Powell?
I was surprised by the extent to which he stressed patience in 2 ways. Patience with inflation running higher. He basically dismissed the fact that we've had some pretty surprising, hotter than expected inflation prints. And then the second patience with the balance sheet, saying, you know what, we may get there slower than we would have otherwise, which means that monetary policy is going to be more expansionary than it would have been otherwise. So I was struck that on the balance sheet, he took such a big step forward when he could have waited till the next meeting to do that.
So we keep wondering what shoe is going to drop, right? We keep thinking everyone's bullish and then more bullish and then bullish on top of bull. And you have to wonder, okay, well, when does something break? And we were talking on Wednesday, it's the inflation expectations, that at some point this is going to be a higher, more inflationary environment with a Fed that is less willing to fight it. And yet I'm not seeing it in break-even rates. I'm not seeing it in other places that you normally would. Why do you think that is?
You're seeing it in gold. Look at the reaction of gold, record highs on gold. I think what you're having is, and you've all said it really well, the everything rally. So it's going everywhere. What's interesting now is this notion of market enthusiasm, not economic enthusiasm. There's a big difference. Market enthusiasm could spread to the rest of the world. And that is quite a consequential statement. If that occurs, then the U.S. relative strength is going to be somewhat diminished. I think it's actually too early to pivot. I do think that, to use your phrase, U.S. exceptionalism, economic exceptionalism, isn't going to expand to the rest of the world. The U.S. is really exceptional when it comes to its economy. The others aren't doing what the U.S. is doing in terms of investing in the future drivers of growth. They don't have the entrepreneurial society that we have. They don't have the mobility of factors of production that we have. The U.S. is truly exceptional among other advanced economies.
So do you think it's rational for people to stay in the United States and to keep adding more, even if valuations are at such high levels relative to the rest of the world, to continue to kind of bet on this ship and not expect it to expand elsewhere?
So I've been asked that question every single year for the last 5 years. And every single year, the U.S. premium has increased. And every single year I said, don't fade the U.S. too early. I see some argument for diversifying away from the U.S., purely on this enthusiasm. and on relative valuation, but I don't see it as strong. It is not being supported by fundamentals. People have to realize this. This is more betting on the momentum, and I understand that. The momentum factor is very strong right now.
You mentioned just a moment ago there's enthusiasm for the stock market. There's not enthusiasm for the economy. Well, does that not make any sense?
So the reason why it makes sense, and I've learned this the painful way, is that markets are not the economy. Markets can decouple from economies for a very long time. And we've seen that happen over and over again. But there are parts of the world, for example, one of the biggest puzzle is while you've had a surge into inflows in US high yield and corporate bonds, investment grade bonds, you haven't had them in emerging markets. And people can't figure, so we have this very peculiar situation whereby it is US investors managing US investment grade bonds that are taking off benchmark bets in emerging markets. And I think that's because most investors think it's enough to be in the US.
You wear a few caps. Can we go to the Gramercy cap and talk about what's happening in EM? What's the reason for that? What are you and the team over at Gramercy thinking about EM at the moment?
I think that people have been hurt so much, and people like, same reason why so many people are in cash, they think they can get adequate returns from safer places to be in.
If we were looking at EM and we saw a central banker that appeared to tacitly accept high inflation for longer, I think we'd be doing something very different with the assets of that country, particularly with the currency. Why is it different with the US?
Because the US issues the reserve currency, because the US is the place where people outsource their savings to be managed. The US can misbehave, quote unquote, much longer and in a much bigger way than any other country in the world.
Which is the reason why we've all been waiting for this to show up in longer term bond yields, and waiting, and asking lots of people the question, and everybody says it's not going to happen because we're the reserve currency of the world. At a certain point, is the concern about inflation only going to show up in gold? Is this the only place, or will you start to see it wake up? Is that something that you're willing to bet on?
Look, we've set aside three concerns that are still in play. We just are not focusing on them right now. One is the US deficit and the tremendous amount of issuance. I remember being with you back in October where the question was, who's going to buy all these bonds? No one cares right now. So that's issue number one. Issue number two is we've taken a small step in Japan for exiting from a highly distorted monetary policy regime, and we have a really long journey ahead of us, but no one is asking the question, will Japanese investors have to sell all these foreign securities they've bought? And of course, the third one is the banking system. This is not a banking system issue. This is a few banks that are still facing difficulties. And that is going to play out this year, but it's not a banking system issue.
You talk about Japan, and let's go there for a minute, because they did come out with some inflation numbers overnight that were hotter than expected. And yet people aren't concerned because it seems like the BOJ put is as consistent as the Federal Reserve put in terms of not overhiking or being overambitious about how much to really tighten the screws. Does that make you think, you know what, even if that's a sort of outside threat, that's not going to happen? This isn't a normalizing cycle. This was simply kicking the goalpost a little bit further out the field.
So Lisa, you're doing what John does, which is get me on a Friday, and then I front run my Financial Times article coming out next week.
It's okay, no one's listening. Go on.
So I think we're going to look back this week, as the week in which central banks abandoned a point inflation target for a range. That we're going to look back and say this was the point when they realized, in the case of the Fed, for example, it's no longer a good idea to have a 2%, let's have 2 to 3%. It's going to happen in a very slow way. The first step was taken this week when you acknowledge that inflation will be higher, you acknowledge growth will be higher, but you see straight through it. Japan, same thing happened. So we're going to look back, and this is my hypothesis on this, as this has been a really important moment, but it's going to play out very slowly. Japan is going to play out very slowly. They will tolerate hotter than expected inflation for much longer than anybody expected. Now, if you're in the equity market, that's music to your ear, as long as it doesn't get out of control. And so far, inflation expectations have been relatively well anchored, as you said.
Raises questions about what it means for the bond market. We'll talk about the consequences a little bit later. That was the greatest promotion that the FT's ever had. Mohammed. They'll be happy.
You do it to me every single week.
But it's good for everyone. We get a little bit, they get a little bit, everybody wins, okay? Don't they?
It's the everything rally.
It's the
literally
everything
in everything. Yes,
Literally.
exactly.
Thank you. Mohammed's going to stick with us, I'm pleased to say, through most of this hour. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackes. Hey, Yahara.
Hi, John. Reddit rose 48% in its trading debut yesterday, with the social media company closing at more than $50 a share. That's well above its IPO price of $34. Investor enthusiasm for the listing driven by the company's pitch to profit from the growth of artificial intelligence. Reddit's IPO is the 4th largest on a U.S. exchange this year. At market close, the company had a market cap of $8 billion. Investors took a $113 billion bite out of Apple's market cap following regulator moves against the company. The DOJ and 16 attorneys general filed a lawsuit accusing the iPhone maker of blocking rivals from accessing hardware and software features on the iPhone, a claim Apple strongly refuted. Across the Atlantic, the company is also said to be facing probes about whether it's complying with Europe's Digital Markets Act. And Tesla is pulling back electric car production in China amid sluggish sales growth and intense competition in the world's largest auto market. Sources telling Bloomberg the company instructed employees at its Shanghai facility to lower production of both the Model Y sport utility and Model 3 sedan by working 5 days a week instead of the usual 6.5. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, regulators closing in on Apple.
Apple has maintained its power, not because of its superiority, because of its unlawful exclusionary behavior.
That conversation coming up next. Live from New York City this morning. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Four-day winning streak on the S&P 500. Longest daily winning streak going back to early February. Adding some more weight to that. S&P 500 futures right now up by 0.15% on the S&P. Calling it the everything rally. Here's a little bit more of it. Bonds rallying, yields lower by 2 basis points. 4.2414. Crude up by 1/10 of 1%. $81 on WTI, and the dollar stronger. The euro down to 108.21. Under surveillance this morning. Regulators closing in on Apple.
Apple has maintained its power, not because of its superiority, because of its unlawful exclusionary behavior. Monopolies like Apple's threaten the free and fair markets upon which our economy is based. If left unchallenged, Apple will only continue to strengthen its smartphone monopoly.
It's the latest this morning. The DOJ suing Apple, accusing the tech giant of blocking rivals from accessing iPhone hardware and software features. Apple are raising $113 billion in market value. The iPhone maker pushing back, saying the lawsuit could, quote, set a dangerous precedent, empowering government to take a heavy hand in designing people's technology. Bloomberg's Michael Shepard joins us now for more from DC. Shep, can we just start with the so-called Apple monopoly? What are they getting at here?
Well, what the Justice Department alleges is that there are certain features that people value in smartphones that Apple is tinkering with in a way that creates an advantage. This includes cross-platform messaging, say, between Apple devices and Android devices. It includes digital wallets and also support for non-Apple smartwatches. And then finally, also cloud streaming services. And what it is saying is that Apple is putting its thumb on the scale in a way that hurts not only consumers, but also the makers and innovators in these areas who are not named Apple.
Shep, the Wall Street Journal editorial this morning comes out and says the suit also claims Apple has, quote, suppressed mobile cloud streaming video services by requiring each to be submitted as a standalone app for approval. And they say LOL, as the kids say, because the FTC claimed that Microsoft Activision Blizzard acquisition would create a cloud video game monopoly. So is the DOJ, FTC, these regulators basically talking out of both sides of their mouth?
Well, that is, in a way, what it looks like, and that is certainly what Apple will try to argue, because when you parse Apple's statement from yesterday, and Jonathan was good to show an element, a segment of it. In short, they are saying that they're being punished for being innovative, for succeeding, and for drawing consumers. They say that, look, don't blame us for people liking our products, for people gravitating to what we have to offer because of enhancements like security that people really value and that we're able to bring by setting higher and different standards for access to our App Store, for instance.
Let's talk about the politics of this. We have seen a robust regulation from the Biden administration, a more amped up DOJ, FTC, but this lawsuit, the inquiry of it started in 2019 under Trump. Do you expect, whether we get Trump or Biden, this is the direction of travel?
It's an interesting question, Anne-Marie, because we are in an election year, and there's a lot of questions about what the Trump administration, if he is elected to return to the White House, what a Trump administration would do in terms of its enforcement of the market. In this case, it's interesting. Donald Trump did not have a huge love affair with the tech industry, and the Justice Department under Trump also, as you said, started this case, but also pursued it on a lot of the same grounds that we are seeing here articulated by the Biden administration. And also in the Republican Party under Trump, there is a strong libertarian streak. We are seeing the party increasingly reject scale, in part because Trump is trying to make that appeal to the little guy voters, so to speak.
Shep, I got to say, I know it's kind of a fool's errand, but I'm looking for consistency. I want to understand what the framework here is in terms of what the desired outcome is. Is it national champions? Is it smaller companies? Is it, a democratization of tech? Is it trying to push up tech behemoths so they can compete with China? What is it?
That's a great question, Lisa, in the way, what is their end goal? And when you look at the president's platform, Bidenomics, the whole question of competition enforcement is important. And what they want to ensure is that innovation is not stifled, but that also consumers are not hurt. And it doesn't only apply to tech, although it's getting a lot of attention, of course, in the past few days with Apple, but it does extend to other areas. We saw the Biden administration's antitrust enforcers sue to block the Kroger's acquisition of Albertsons, for instance, trying to crack down on concentration in the grocery aisles. So there is something when you hear from the president's top economic advisors, when Anne-Marie and I in Washington have talked to some of the administration officials, we asked them about Bidenomics, this whole question of fair competition to preserve innovation and fair pricing is something that is very much on their mind. I think they're thinking less of so much national champions than they are of trying to make sure the playing field is a little bit more equal. They are concerned that over the past few decades, we haven't seen as rigorous or robust antitrust enforcement as the public and innovators deserve.
Hey, Shep, great to hear from you. Michael Shepard there, down in Washington, D.C. on the latest with Apple. I'm thinking about who wins, Lisa. A lot of lawyers who are going to make a lot of money, And then I'm thinking of South Korea and China. I mean, who wins here? It's going to be foreign smartphone makers. That's who wins here.
And it comes at an interesting time, ahead of what Samsung is expected to do, which is launch an AI-infused phone that's going to change our sort of experience, is what they are saying. And we have Apple racing to catch up with the Gemini partnership of Google. You just have to wonder, what's the ultimate goal? And if you don't have one, how do you sort of create enough consistency to give people the confidence to actually make deals, to go out, have a framework or rubric for their business? I mean, there's some real questions here.
This came up at Bank of America earlier this week. How do you get together and have a conversation about doing a deal where you feel like if you're about to be acquired and you sign up to that, you could be hung out to dry for a whole year, waiting for the regulator to decide whether or not it's bad for business.
And on the flip side, you've got a regional banking crisis that people say, well, there's just too many banks. There are too many banks, so you need to have more consolidation, but we don't want consolidation because we don't want to have dominance. I mean, it's sort of, it's a little bit mind-bending, so please forgive me.
And Mohammed, let's talk about this. How interventionist is America becoming?
It's becoming more interventionist. I don't think there's any question about that. But the more interesting question is, does it need to be more interventionist? There is a view, which I must say I have some sympathy with, that industrial policy is going to be really important in pivoting from old-style growth models to new-style growth models. And you're seeing it not just in the US, you're seeing it elsewhere as well.
Well, and this is actually one of the reasons why, when we're talking about don't fight the Fed, the Federal Reserve, but also don't fight the federal government, because this kind of industrial policy is going to be crucial if you want to shift away from some of these supply chains. I remember maybe a year ago when people thought this would be inflationary. 6 months ago, people thought this would be inflationary. 3 months ago, probably going to increase pricing. Now people don't care. Why?
The reason why people don't care is because inflation has been coming down, and it has been coming down without a sacrifice in growth. So it's not a top issue right now.
But is it inflationary?
Yeah, sure, it's inflationary. Of course it is. All the restructuring that's happening in the global economy, other than AI, life sciences, are inflationary. The rewiring of supply chains for geopolitical reasons, inflationary. The rewiring of supply chains because companies want more resilience and not just efficiency, inflationary. What's happening in the labor market in terms of mismatches between skills and what people have, that's inflationary. So you have all this going on. On the other side, you have the promise of AI, you have the promises of life sciences, and people right now are completely focused on the promise and are willing to live with all these other restrictions ongoing.
We posed the question earlier on this week, and there was actually a really decent piece in the Wall Street Journal yesterday. I'm not sure if they've been watching Bloomberg surveillance through the week or not, but whether America is becoming more like China, as opposed to an era where we believe China would become more like the United States. Is America becoming more like China?
That's like saying that I, as old and as unfit as I am becoming more like an Olympic athlete. You know, could I take a small step? Yes. But am I becoming anything like that person? No.
I'm not saying they're going to become full communist overnight in Washington, D.C. There might be some Republicans worried about that in the Democratic Party. I'm not saying that. I'm just saying we look a little bit more like them than they do us in the last couple of years, and that's not what we expected.
Well, we look a little bit more like Europe. We've realized that government has to play a bigger role in enabling the private sector, and we've realized that private-public partnerships matter.
Mohammed's going to stick with us. Coming up next on the programme, we found a little bit of an equity market bear, which is refreshing because everyone on this programme at the moment is very, very bullish. Tracy McMillian of Wells Fargo, as the S&P 500 hits its 20th all-time high in 2024. That conversation up next, live from New York City. This is Bloomberg.
I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.